We'll do it live.
Okay.
We'll do it live. F it. Do it live. I'll write it and we'll do it live. F***ing thing sucks.
Yeah.
All right, welcome back, everyone. Andrew is back, and hope you guys enjoyed our, totally accidental.
100% accidental.
Yeah, totally accidental of us showing up on camera dancing a little bit to the music.
If you guys ever want to know what goes on behind the scenes, now you just got an insight into what we do before the stream.
That's how we amp ourselves up. We don't need substances. We just need our own energy, and whatever's in this, you can assume whatever you want. All right, so Monster Energy. So the topics that we are going to be discussing are actually listed in the description below, alongside with the link if you want to join the Capital Mindset Club, which, by the way, the prices are going to be going up by the end of this month. All right, that being said, oh no, yes. With that being said, the rough, I guess, organization of today's call is also listed there. For the first 15 minutes, we're going to be discussing the markets, kind of asking Andrew if he wants to know about a particular thing that he might have missed while he was on vacation. But for the most part, you left in the midst of the market somewhat temporarily bottoming on Monday, Tuesday, and then you missed out on Meta's collapse. And then what else did you miss out on? I mean, obviously the earnings.
Tesla's rally.
Well, Tesla's rally you were here for, right? Did that start Friday?
It started the last week on earnings.
Oh, that is right. That is right. It started Wednesday of last week. I got my time. See, I need the reminder. You don't need the reminder. I need the reminder. You're more up to date than me.
One of my stocks had a very good week last week.
Which is?
Vertiv.
Oh, VRT. Yep. We got to talk about VRT today. That is one of the discussions when we talk about data centers. So first, I think let's discuss the broader market sentiment as far as like you guys are interpreting it. How do you guys feel the market's feeling right now? Do you think investors are a little bit skittish? Do you think they're really bullish? How do you guys feel?
You go. Do you want to go first, Bacon? Or you want me to go first?
I will defer.
Okay. So I actually think you hit the nail on the head in your private call last week, which I listened to on my flight back home. Basically, I think you got to think through like the mind of what a hedge fund manager has, right? So what's your incentive as a hedge fund manager? So like your incentive is based on your yearly performance, right? It's not based on, you want your portfolio track record will eventually lead to you getting more capital inflow. But like as a PM or as someone who's looking at the market right now, you say, we could at any point have the economy tip over. Like that's what people are always worried about, right? People are a little uncertain, but there's nothing really there that you can see right now that's saying the market's going to flip. But I think what's happening is you've got 10% gains this year, or like 11, whatever the market is. I don't know what it's at, but let's assume most of them are like 2% of the market, because obviously they're generating you alpha as your. So you're saying, okay, well, if the market flips, the last thing I want to do is have a red year, which is never fun if you're managing money.
No.
And so they're being very defensive in that regard. That's how I feel. I also think maybe there's a little uncertainty with what's going on before the elections start. But I think once the election season gets into the swing of things, we'll be completely fine and this market will rally. So I feel people are skittish, but I think that the actual fundamentals of the market are fine.
So more importantly, you're taking a bullish stance right now.
Yeah.
I know that you were on vacation. So for some context to our listeners here, so in the Capital Mindset Club, we do the weekly call once a week. And last week, the call that he was referring to was at the beginning of last week, basically making a sort of primary topic towards the beginning of the call discussing current market sentiment, and that was discussing why the sell-off, if you want to call it that, which really was a retracement from the highs of earlier this year down, I guess about half of the gains were gone when all was said and done, that was a sell-off based off of investors just kind of looking for a reason to take profits on anything. And on those kinds of dips, we really want to try to see if we can buy any opportunities that we want to, I guess, focus on. So your main ideas, things that were on your watch list. So there's nothing really wrong right now. Nothing broke. Nothing scary is happening. Those kinds of dips are fairly easy, I guess, to mentally to buy up. And that's what I did. We won't discuss exactly the methodology because I kind of I want to. Yeah, exactly. Yeah, Andrew's laughing because Oh, you're talking about Dom stocks. Are you laughing at Dom stocks?
No. I was laughing at what you were saying.
Oh, okay. I was like, but anyways, regardless, the call was going basically long beta and maybe long leverage beta. I don't know. But, yeah. All right, Dan.
But you just went all in on private equity.
That might come one day. All right, Dan Bacon, what do you guys think? Because we also got to talk a little bit about Tesla before we run out of the 15-minute mark. Because we're on a time. We got a schedule to keep. Yes.
I find it funny with this like this. I feel like Elon is just trying to do whatever he can to get that compensation package passed. He is throwing everything out there to the people. Like, whatever he can say, hey, look, I got robots, AI, ride share. Oh, now I got to deal with China. Like, what else you want from me? Shoot rockets at Mars. What?
Yeah, he's really okay. So for, I guess, the full story, we should talk about the full story. Tesla was on a trajectory downward, and we had the clowns really talk about. I will highly contemplate releasing the beginning part of the weekly call for last week because there was a part that was very interesting, talking about these retail investors on FinTwit mainly and what they would do before they did it, by the way. That's how you know they're just NPCs. Sorry, that's a little mean. But no, in all seriousness, basically kind of seeing what they were going to do from a mile away and seeing how you could, or emphasizing the point that an investor could lose 90% on a particular investment without the stock actually going down 90%. And that's just, you can do that by playing with the soap a lot, revenge trading, whatever you want to call it. So yeah, Tesla, he goes to China and apparently comes out today with news that they get approved for full self-driving. Now, Dan here has been a huge proponent of full self-driving. He's actually said it's the safest thing on the planet. It's going to pass all regulators. Whatever regulator looks at it, it's going to say, yep, that's good to go.
Fabio gaslighting in real time.
I got to do at least once an episode. So in reality, that's a complete opposite of what Dan's been shouting from the rooftops. What would he know? It's not like he's experienced with that kind of stuff. So
I tell you what, I'm telling the National Highway Transportation Board is investigating FSD. California is, and Florida. I'm telling you. And there's going to be more civil lawsuits related to people dying. There's only been a handful so far. So those are coming.
So investigating meaning what?
Yeah, I guess that's good to break down a little bit.
They've just been the behind the scenes. They have some data that they've been tracking, like autopilot features. So they have reports on autopilot, and I forgot what they call it, level 3 autonomous driving. So they're tracking that stuff, and then people complain. Governmental organizations will complain, and enough of them did that they started looking into FSD. So they are investigating. There's not much more you get at this point until they release an official report.
Gotcha.
Okay, so thoughts on Tesla. Are you buying here? Do you think it's a good buy here? Or you kind of looking at this and saying, oh my goodness, have fun?
There could be trades here, but I mean, still investing in it. It's like,
yeah, the hell do you mean investing in it?
Right. We saw the points that a lot of investors also pointed to on the earnings call regarding the actual business and the growth rates that they were touting at that time, and everyone was disappointed, it seemed. But what Elon was talking about with the future for Tesla is what really got the animal spirits going. You had prominent Tesla bulls come out and say, yes, is what I was saying. And the day before, like the week before, saying, yes, we're proud that we trimmed Tesla. We think it was a good call. Again, that's why I really want to release that first part of the weekly call from last week, because it was before Tesla's earnings. And it was talking about this very topic.
I'm not long or short. I wouldn't play with it right now. I think that a lot of the recent movements based on some, I'd say like the best way I could explain it is like potentially speculative, far like distant cash flows. Can you do me a favor though?
Yes.
Can you pull up the Tesla chart?
Oh,
you gotta
you're going
remind
there.
the people that certain strategy.
And can you compare the 1-day chart to the 1-day Tesla chart?
Of course.
And explain to people what just happened.
Of course. So
why you overcomplicate this?
If you guys don't know, I debated the most intelligent YouTuber out there on this very topic on his own channel. And the discussion was had about Tesla and Tesla and basically all yield max strategy funds and why they don't make sense in any way that you kind of square it, because you're taking on the same amount of risk, all the effort, the same amount of effort for the capped upside. And so you will always underperform the underlying if the underlying's good, if it's worth its salt. If it's not worth its salt, you're going to feel that too, because you're going to get the same downside, if not more in some cases, depending on how really the volatility plays out. So really, it's all dependent on exactly the precise nature of how the stock goes up or down, how that's going to really affect the delta between the performance and your investment in Tesla versus the underlying. There are some scenarios that are really specific, you could argue, in which this fund will outperform Tesla over maybe a period of time. We get into the problem that Bacon likes to talk about of periodicity. So is that proof or evidence in and of itself that the strategy works? Not really. When you really break it down, you have an investment strategy that sells the upside by selling covered calls. And I believe this time around, the covered calls had a strike of, I think, $180. So it experienced some of the upside, but not the rest of the upside. So, yeah. This debate that I had with this individual, I think, was in like February of this year. And the person just went over their head completely. Just loves one.
I just want to say it's relevant for this because this is the exact problem with these funds.
Yes.
Why you overcomplicate this?
I mean, if you are going to hold something long term, like these days like today, if you miss out on these, they have a huge effect on your return.
Mm-hmm.
In general. And like I have probable show, like if you miss like the 20 best days in the market over a decade, like your returns are just like so much, like 70% less. They're so important to have these days. So, and then you don't have those with you're capping that.
Yep. So. I love that study is actually really, let's call it, that's a real rock on the glass house for these companies or for these funds. Because, yeah, exactly that. Most of the returns are really, we can point to very few days in the year that are responsible for that. And that's the danger of doing these sorts of strategies. It's not free money. And a lot of retail investors have more and more recent time, at least, been more vocal about that thought. But they've always been around the covered call strategy themes, the wheel strategy. It's a lot of, if you really break it down, sadly, it's a lot of people that are desperate for income, that want income, and instead of seeking income via, a job, W-2, contract work, etc., they're looking at the markets as sort of like this piggy bank. When I keep trying to preach, when I debated the individual that, hey, well, if you focused on asset accumulation and growing your net worth, income will just come. Right? Pun intended. It will just come, right? So it'll be a problem for you to actually not generate income, right? So it actually, the reverse happens.
But what would you say to the person who's like, well, if I put down $200 in Tesla, or I could put it in Tesla.
Only you can do that
I
accent.
get more Tesla.
Publicly. I can't do that accent publicly. I can't do that.
And big brain move. I use a dividend from Tesla and put it into Tesla.
Let the record show I'd be canceled for doing what he's doing.
I thought you give it to your girl.
Oh yeah.
Oh, no.
I don't do it. I don't do that. I give it to my girl.
Oh my god! All right, well, yes,
that guy,
You got
that
to,
guy.
Fabio. I have. I think I get a pass.
you get a pass.
You gotta pass. Oh, it's
Listen,
because you're also
listen.
co-host with me.
Check private chat why I get a pass.
Oh, okay. All right.
We'll allow it.
I am surprised. I had no idea.
It's one of those things
Yeah.
that I forget from time to time. Yeah.
Well, not.
It doesn't
Yeah.
show up. Your
No,
phenotypes don't show it. All right. Anyways,
Anyways.
Well, I'll explain later.
I'm
but
tripping over.
I think it gives me a pass. Anyways.
Okay. Okay. Well, the next topic that we have going for us, we're 3 minutes late.
Oh no.
SoFi earnings. Okay, so SoFi, this is probably my second largest investment of anything, and I'm absolutely getting destroyed today.
Our first video on this was a year ago, almost to the day.
Very
price
nice.
That
same?
is true. We got to.
It was like May 1st or 2nd last year. Hilarious.
Is true. We're about a year, and what happened? Okay, so let's kind of go. Well, it's actually up 28%, so we're kind of clownish, but
We made money on that a year ago, though, so we're fine.
yes, we did. We actually bought around the time we made the video. That was pretty amazing.
I literally messaged Fabio. I'm like, this is going to $10.
Oh yeah. That was complete another sarcasm. It's not in my portfolio at all. So the only time that it's ever made it in that portfolio is when Dan was referencing the time where we basically traded SoFi on a very small amount, like it's immaterial, kind of a fun test, and off of the thesis that student loans would basically come back, or there'd be news in student loans coming back. And that's basically what played out. But realistically, I have no interest in holding a stock that's kind of like a subprime bank that sort of deals or delves in the or flirts with the idea of it being a technology company, when really it's cope and seethe harder is all I can say.
So explain. So we're going to talk about boring and troubled industries.
Yeah.
Why does YouTube find banking interesting?
Yes. So if you guys have
It's not
checked the description, you see the topics we're going to be discussing towards the end of the live stream. We're going to be discussing boring and unloved industries that are actually pretty good. SoFi is a bank, so it's strangely popular among the YouTube crowd. There's tons of people who talk about it, and so out of sheer entertainment, we talk about it here. Just because, I don't know, I think we all just find it fascinating and cute and adorable that it's so loved. But really, breaking down the earnings, I think it's best that we bring out the investor presentation and start from there.
Oh yeah,
Because there's a lot to cover. So I remember vaguely all the things that we covered in our first video, Dan, about a year ago, and some of the concerns, we'll see if they're playing out or not. So the first things first is we'll talk about this slide, members growing. So this doesn't really tell me anything, if at all. I guess the first thing is that I'll do is express how I view the bank and some of the bull points. A lot of the bull points is that SoFi appeals to Henrys, which I don't really agree, because I think that there's plenty of other banks that offer a lot more services, especially if you're a high income earner. SoFi doesn't really offer any of those really attractive services. I think they're really good for someone who's just starting out. You're a college student, you don't make a lot of money. SoFi is great because they don't charge you fees. They don't really care about how much money you're moving in through their bank on a monthly basis, etc. And so they're good for just getting started. Once you have a serious amount of money, I think that there are plenty of other banks that are much better for you than something like a SoFi. And the interest rate that you get at SoFi isn't even that good, all things considered. I think that sometimes it's really difficult for people to understand this, that what is it, 4.5%. It's still kind of subpar. Some of the, well, I know that you're getting into more serious money, but the bigger banks do offer good interest rates, actually better than SoFi's interest rates. But you do, for some of them, you have to have higher minimums. But even then, what's available to people, it's really, if they want to get a yield higher in excess of 5%, that's pretty much risk-free. It's fairly easy in today's day and age. And hello, Jesse. You arrived just in time. So
Jesse.
with
I have a
members,
question.
yeah, go for it.
What is a member? Because I have a question. So, for example, I used to have all my accounts with Wells Fargo because I had to. Because when I worked in their investments, like in the department there, everything had to be held in house.
Yeah.
After I left, I moved everything out, but I still have like an account there with like 3 cents in it that I can log. I mean, I can still technically go log on, look at my old statements, all that. Do I count as a member at Wells Fargo according to like their metrics here?
Savings, yes. Yeah, if you had an account with them, yes. So this is all the people with accounts. They call them members.
Okay. So this is kind
it's
of
not
a
about
meaningless
active
stat
members
then.
though. It's just somebody that has like a checking
insane.
savings account potentially.
Yes.
That's
So this is what's interesting. If you catch the difference here, product growth versus member growth. Ooh, there's a difference there. Interesting. 44% growth there, 38% growth there. Of course, it's never going to be 1-to-1, but that's the point. All right. So products, this is, of course, like their lending products, et cetera, all that jazz. Every time someone goes to the bank and gets a product from SoFi, you count it in this figure. That's the growth. So this is where they're actually making their money. And a lot of this, personal loans, student loans, credit cards, and all that. The credit card, when I took a peek at it, it's basically a subpar product, pretty bad in terms of rewards. Kind of like meh, if anything. Not good for, frankly, travel. Not good for anything, but it's fine. I'll give them a pass. Really, they're not focused on that. It's a competitive industry and all that. And their charge-off rates are quite high. It's not good. Then the meat and potatoes, really, we have student loans and you have personal loans. Personal loans is like their crutch. That's where they really pivoted a lot of the business into. And I personally don't like that, but what do I know? Because that's the excitement here. And I think their weighted average yield on these loans is like 13 some odd percent. So you need to get that context. Yep, Andrew's eyebrows went up. So that's really indicative of a healthy asset base. You know, that's the kind of things you would like to own during any economic time. Nothing could ever go wrong. And yeah, it's just going to print money up and to the right. And people don't understand that banking is very commoditized. At the end of the day, it's like, okay, let me give you a scenario. Jesse wants to borrow money because Jesse needs money for his multi-million-dollar cabin. And he's going to say, I'm going to do it on a personal loan. And he goes like, all right, I'm going to borrow from Dan. Dan's like, I'll give it to you, but I'll charge you 15%. Bacon comes in and says, I'll give you the same amount of money, same thing. I'll give it to you for 14%. And I come in and I'm just like, I'll give it to you for 9%. Jesse, who are you going to pick?
Ghostbusters.
The lowest.
The lowest, right? All the time. It wouldn't make. So I'm just trying to illustrate a very simplistic example to talk about why banking and money is highly commoditized. A lot of times you're dealing, the most attractive form of banking is business banking, building relationships with your clients and high net worth individuals. That's where it's attractive, not in the consumer banking. It's not the most attractive part of banking, especially in this battleground, which is personal loans, student loans, and all that. It's very commoditized. So it's going to be a race to the bottom. If you're,
and they still don't have a business facing product or not like one that's relevant, right? Because they're a neobank.
Yeah. And yes, this is correct. People will shop rates. So it's very easy to grow. It's very easy to grow as a bank. All you got to do as a bank is do what I did in this case for Jesse over here wanting to borrow money. Offer lower rates. Offer low rates and people will come. And generally speaking, I saw that when I go on various websites, if you're like looking for the top rated or comparable, personal loan lenders, SoFi always comes up. And usually I think the average range for the interest rate on the personal loans is fairly low, high for, all things considered, but low in comparison to some others in those lists. Now, that's not really indicative of anything. We can't really base anything off of that. That could be just, kind of noise. But for the most part, you just got to understand that banking in general, it can be a very good business depending on where you're focused, but it can also be just a very crowded and commoditized business. SoFi is trying to grow through marketing. This is another point, and I think Dan loves this point, right? Dan, what have they been doing for marketing?
Marketing.
Their deals, the NBA.
NBA.
Oh yeah.
Yeah.
The friggin', which is not. We still don't know what it costs.
Mhm.
Yeah. So they did the partnership with the NBA.
They not disclose that in their 10Q?
I
No.
couldn't find it. I searched every term of basketball. Oh.
Yeah, that believe it or not, with the more bullish SoFi people that I endured today, they all actually agreed. They were like, "Yeah, this is we want to know the details around this. Can't find it." So
Got the
think of that
basketball
when you will.
deal. So they're an exclusive partner of the NBA and a few of the NBA players.
Yeah.
Plus they're paying the NFL rights to the LA stadium. And that payment accelerates every year based on economic activity. That's what they have in their filing.
Okay, so I see
look.
their 8K. I don't see a 10K yet.
Oh, look. All right. Well, what do we
I
have?
didn't check if they had a separate filing for it yet, but
There's probably something out there, but not many. Maybe there's not much details. So what do we have in front of us here? We have actually the first bit of good news, because the last time when we first talked about this, you and I, Dan, what did we talk about with Galileo? We said, I wouldn't be surprised, or we wouldn't be surprised if we saw growth deceleration. That's what we saw.
I said, yeah, it was like unimpressive growth at the time for what they were telling us it was. Like,
oh yeah, 20%. It's an acceleration, but it's still too small.
Yeah, but like that's a very favorable time period. Like if you just look at this graph, that's not good growth since Q4 2022.
Yeah, since Q4 of 2022. Now, if you want to break it down sort of like at a logical framework, this is the best way I can explain it. It's kind of just using sort of your business acumen. All right. Another example, I'm going to use the panel, pick at random. So Jesse has developed a really good fintech platform. I am a bank. I have my own fintech platform. Bacon and Dan are banks. I'm going to go to them and say, hey guys, I compete with you. Do you want to use my tech stack? Jesse, pure play fintech. He has his own tech stack, competes against mine, and he goes to them and says, hey, you want to use mine? I don't compete against you. I just want to help you with your technology platform. I have to make a case that my technology is that much better than Jesse's, that if they don't choose me, that they are screwed. And so it's similar to how you kind of say AWS. Would you be surprised or not surprised that Walmart doesn't use them?
Not surprised at all. And Dan would use his own tech stack because Dan is JP Morgan.
I just would imagine Jamie Dimon just laughing at them when they asked if they want to use this.
Well, they're supposedly talking, and that's the thing that I think a lot of the investor base got really excited about. They're talking to I think a top 5 US bank, but they only showed like proof of what is it called in software? It's not proof of concept.
Concept?
Is it proof of concept?
Are you talking about MVP?
Minimum viable product.
No, because they already have an MVP because they're
I was gonna say, if they did that, that would be horrendously embarrassing.
You know about the pitch they would make to the top 5 bank?
Yes, effectively it was a pitch kind of showing them how it would work for them. That's all they got through, because we don't know we don't know. I'm acting like I'm an investor in this. But point is, it's not known yet if it's a deal that's kind of making its ways through to the end stages. I think in the earnings call, I skimmed through. It didn't seem like there was much on that. Just again, kind of touting it, but nothing clear. So, yeah, the good news is that Galileo is a tech platform, and Technesis, all fintech, it's fairly sticky. Once you get a bank customer, they're not gonna want to leave. it's really hard for them to rip out the roots and go to something else.
So the counterpoint about this though is like there are products, even if it's from a competitor, where if the product itself isn't massively revenue generating or it's like a small piece of the pie, you might not care if they get that. And the other thing I was going to add, like, so there could be an argument where they say, hey, JP Morgan will sell this to you. And for JP Morgan, it's such a small, insignificant amount. They might, like, you know, there could be niche parts of the market where it doesn't make sense for JP Morgan to go after it, but might make sense for SoFi. Could Galileo fit within that? That, like, I don't really know what Galileo does. If people can't tell, I'm just kind of sitting here absorbing what you guys are talking about.
I am betting JP Morgan has a much better fintech stack than.
Well, I just don't know what Galileo is. It might be like kind of a niche product that.
No, it's not niche.
It's not really.
No.
No, that's why the Bulls are touting LATAM as the area of growth.
Wait, actually, okay. So I haven't watched really, or I haven't had the time to. Bacon, can you help me out? What is, or help the audience out too? What's the
bull case for this?
No. What are they saying? You said that they said LATAM.
Yeah. So, like, you know, generally speaking, that Latin America, South America, like broader region.
Yeah.
That appears to be where either the management team or the investor base is hoping, the bullish investor base is hoping that SoFi expands to. We can make of that what we will as far as quality and revenues or what have you, but
all right, cope and seethe, like the thumbnail says, cope and seethe harder. So we're going to this next slide, and this part's again, it looks good, right, on the surface. Lending products, financial service products, we see strong growth across the board. And again, the difficulty here is with a bank, you're dealing with a lot of commoditized products. It's very easy to grow as a bank. It's not difficult. It's probably one of the easier business types to grow. It's just about, is that growth responsible or not? Like, the market is massive.
There's only one industry that's probably easier to grow.
What?
Insurance.
Oh, yeah. But same principle applies.
Yep. Same,
I'll
exact
insure
principle.
the same building and I'll charge you way less. I'll take on way more risk. And of course, I can grow. I can get tons of clients. Everyone's going to be like, yeah, Fabio's insurance business, it's great. It's so much cheaper than everyone else's. Why would I not go with his? Why would I pay more? It makes no sense. And then here I am degenerately leveraging up my balance sheet, and I have all these liabilities stacked up, and something bad happens, then I'm gone.
Exactly.
So yeah, great example. Okay, so we're still good on time, and this is something that they do tout. They're trying to say this is like them trying to pivot. We are a tech company. We're not a bank.
Ecosystem. We got ecosystem and flywheel.
Yeah, they because they're well aware of people's concern about having such a dependence on personal loans, and this is their attempt to soothe you, even though I think it's kind of bullshit.
So money. Okay, I'm confused about this chart. I don't follow. So you have money, which I'm assuming is money accounts, like checking accounts.
Yes.
Invest accounts.
Mhm.
What's Relay?
A race.
I'm pretty sure that is one of their tech platforms. Not like that's what it's called, but that's the act of doing it.
Okay.
Relay account.
Then you have credit cards.
Credit cards.
And then you have personal loans.
Mm-hmm.
SL would be
Student
loans and home loans.
I would assume so. I could be wrong. I've been wrong before.
Okay.
Yep. Yeah. So the Relay accounts, it is that. It's part of their fintech platform.
Why is credit card on
wanted
that
to make
side of the chart?
It's on both sides.
No, but like you have money, Relay, invest. Like that's like people, like that's where you get money from. And then you have like the loans on the other side. Shouldn't credit cards be like with the loans?
I guess, yeah.
Don't question innovation, Andrew.
I'm just saying, I'm like looking at this and trying to understand, like, how they're categorizing things, I would put credit cards in the loan category. I don't know if they're trying to say that's like they're trying to say that's not a lending product. I disagree.
Yeah, the relay, the relay, it's part of like their innovations for as a platform that you can see all your stuff in like one go. So I think that they're just doing like your money accounts, investment accounts, relay, which is like you have your I mean, honestly, that's not really innovative because every bank does it, but like your dashboard.
Wait.
This is one point to bring up. Like, so now they're
savings.
trying to go into real banking, competitive banking, right? Like personal and student loans, they can grow that probably pretty easily. Like, look at the barely any growth in credit cards and home loans from these 2 quarters. Like now they're getting into real competition from, and like they're not making much headway.
I don't know about that. I would say on a nominal basis it's not that high, but on a percentage basis it's actually fairly high, isn't it?
Mm-hmm. For which one? Student loans or
student loans and credit cards?
These are quantity. These are not dollar amounts. Quantity of loans.
I'm just saying, like he's saying, there's not much. Like going from 26,000 home loans to 31,000 doesn't sound like a lot, but then when you actually do like on a percentage basis, it's fairly decent. I mean, you don't necessarily want decent like grow. This is I hate so much about this. Okay. If you're a bank, this is not how you should be looking at your company.
But it's not a bank.
Okay. Yeah, exactly. Okay, Andrew, but it's not a bank.
Tesla's not a car company.
Clearly, Andrew. Clearly it's not a bank because you don't even know where to put lending products in the right category. So, like, I know you're not a bank. I don't know what you are, but you clearly don't know.
Credit cards. Yeah, I see your point. Credit cards should be down there because the money, invest, and relay, like relay money, that's almost like liabilities to them. That's just like the customers' accounts or customer members' accounts.
The other thing too, that to your point, it doesn't matter the number of accounts. What matters is the dollar amounts when you're a bank.
Yeah.
Like, what's your like? I don't know what they're trying to.
They're just trying.
I don't get this.
Okay, I believe
it makes no sense. Like what they're trying to tell you.
What they're trying to say is that we're not just lending; we're other things.
No. But all of their like revenue comes from lending, right?
Yes,
like the vast majority of it. So basically, they're saying we have a lot of total like financial services, and they all suck.
They're trying to tell you they're not just personal loans.
We can't make money off of
This is what they're trying to explain.
Like,
yeah. Like a lot of this up here is liabilities. So I don't get it either. Well, I get what they're saying in a way. Like they're saying that we have a lot more relationships with people, being their bank of choice for where their money sits at. And so in theory, I don't know what they're implying there, but maybe they're implying or talking or highlighting some sort of like how liquid they are, how much liquidity they have. Could be. I don't know. But it's not telling me dollars.
If you wouldn't imply liquidity, you need to say dollars because
I don't know that exactly.
Because
it's useless.
A money account is not going to be as large as a home loan.
Yeah. No, I agree.
I think it's funny though that Relay is also up there. Like my understanding
all of those products are $10 buy now pay later services for Amazon.
Yeah. Well, here's the thing for me with SoFi Relay though is that like according to SoFi's very own website, it's a free product. More or less, all you do is get to see different accounts, like all in one place. See and track debt and expenses.
It's like Mint then, right? It's like nothing special.
Like hell, like so many
there's
banks
like
and even
tons of
unions.
Data aggregators out there.
Yeah, like even
and
banks
you're
and
never going to pay
for
for them.
Yeah, like that. That's all it is. Like we're viewing that as something to get excited over when the end customer doesn't pay for it at all so far.
And if they're saying if like in that previous chart, if they're using like certain APIs or certain features within their data aggregator as a financial service, like financial service, they're just pumping up what they're trying to show as them being like not a bank, but really they're just a bank with a data aggregator. I don't know. That makes no sense.
And then we have, of course, this slide, which is illustrating just the comparison quarterly adjusted revenues on the side. On the other side, we have quarterly adjusted EBITDA, which is my favorite measure ever. Adjusted EBITDA is always superior to regular EBITDA
For a bank.
for a bank. Yeah.
Yeah.
It's the best they could give you. It's all-
Andrew, I don't appreciate your lack of innovative thinking.
You know, they're like 80% personal loans. No presentation slides about, charge-off rates, credit loss, nothing.
Didn't they
And-
increase the charge?
Don't even want to talk about it on here.
Okay, so this is a good point that Dan is making that should not be just glossed over, because someone will say to you, but they disclose that they have it in their quarterly filings. Yes, but what Dan is pointing out correctly is that this presentation is meant to be sort of like the nice little pictures for the shareholder to kind of shift through, etc. And it tells me sort of as an investor, what are you trying to highlight to me? And potentially, what are you not trying to highlight to me? What are you trying to go, no, don't worry about that. That's not important.
Oh, I
But
found
this
it in
is
the
really
10K,
cool.
though.
You found it.
Page 103 of the 10K.
Page 103 of the 10K.
You can see what their charge-off rate is. So
Okay, let's go there. SEC filings 10K.
Oh, but Dan, you're just a bear who only cares about the one quarter, or this is SoFi's transition year.
I'll
You're-
find
you're-
it. It's freaking
Don't worry,
embarrassing.
zooming in.
Page 103 at the bottom.
Oh, sorry, 103 there. Okay.
Yep.
Down here.
There it is.
Yep.
Look at the ratio change.
Oh, that's weird. They put credit cards alone here. Why is it alone here?
What?
What?
Why is it alone here and not in the presentation? Yeah.
Wait a
Very,
second.
very astute observation, Andrew.
It's almost like they're run by a marketing guy, not a bank guy, and he's just trying to spin things.
Well, don't want to. Isn't he one of the guys that was like a big bull during .com bubble?
I don't know. I think you know that more than I do.
I got to refresh my memory, but I want to say he might have been. But
Yeah,
JC.
yeah, but was he sell side though? Because if he's a sell side analyst, of course he was going to be.
yeah, no, he was definitely sell side. He was at Goldman. So, just a guy that's representing. What is this? Oh, the results versus guidance. I think this is part of the reason why. Is this showing forward guidance?
Forward adjusted guidance.
I briefly
Trying to read this
listened
here. So.
to
Yep.
like a couple SoFi bulls talk about it. It seemed like there was a one-time benefit that really made their adjusted EBITDA as well as I think their net income look higher than it was by 60 million, which is pretty significant. And then I guess Q2 guidance was soft.
Yep.
Q2. Okay. Yeah. I think that would be responsible for this downward move that we saw today, but because we're down 10.48%. Wow, it fell even more because when I looked at it, it was down like 9%. So, all right, we just passed the minute marker. So conclusions on SoFi. Like it, dislike it, love it, hate it.
This is one of the stupidest growth and speculative growth investments I've ever seen proposed on YouTube as far as risks to reward.
Sad face.
Blows my mind that people are interested in this company every time they talk about it.
Also,
Agreed.
I'm just double checking to make sure I'm not talking on my butt here, but I'm pretty sure if you're a bank, you don't want to have rapid share dilution as a shareholder.
Oh, you think so?
Yeah, like insane.
Andrew,
Share
They
dilution.
saved $50 million diluting us, shareholders, right? That's all that matters. They're
Yeah.
genius.
Wait. We?
Hey,
I'm not a shareholder.
That's the meme.
your name is
We.
so
Yeah. Is it consistency like SoFi dilution? Yeah.
We
Walks out.
this thing is flaming hot trash in my
I mean-
opinion. Not for me. Like
It's not a zero though.
There could be a
Until
point
it is.
somehow.
Okay.
like
Well, if the
So
loan
okay,
book
the
flips-
thing that I do not like about like SoFi in general is if like you're investing for the Stack platform, then the Stack platform has to have some type of a advantage over, you know, gaining like some type of edge on risk adjusted basis for loans, right? If you have that, then you could sell that to a bank for a lot, right? And you could just run the fintech platform or like for banks off of that. If you get customers that are decent, right? The customers are always going to be looking for lower and lower and lower rates, right? So even if you lock in customers, they're always going to be basically pitting you against other banks, driving down what they're going to be paying in interest. If you're not getting high quality customers, then you're basically going to have to like have a poor loan book with high interest rates and high charge-offs. And if you're not managed well, like one little thing can just cause you to implode.
It's true.
So, out of
Actually-
curiosity, if we wanted to say, what size or market cap do you think is appropriate for SoFi in the present day as a fun game? There is no wrong answers. It's just throwing stuff into the wind. Everyone's now looking and doing faces.
oh no,
I'd say
simple.
somewhere around $1 billion, maybe.
$1 billion? Okay, so we have $1 billion with the current
What's
market
it
cap
at right now?
7
It's at
billion.
7.
A market
I would
cap
give it. I
of-
would give it a slight premium over Ally Bank. That's how I would value this at.
Slight
I-
premium over Ally. Okay.
I would give it a
Uh,
yeah, right now and for the future, the forward and current ratio of price to not for me.
Price not for me. All right,
Yep.
fair enough. And I guess it just leaves me. So I was playing around and penciling through some scenarios, and I kind of came across a very generous, let me just say very generous. And I think the highest I could kind of get to, let me emphasize once more, very generous, was like $4.03.
yeah.
Very generous.
Yeah, when I dug into it more like maybe a year ago after it was really starting to tank hard, like the most I could give it was maybe like 450. And I was like, I really
range,
don't know though. Like it's one of those where if it gets down to those type of levels, it could be for a very good reason. It could be going to 2 or 1. Like,
Yes.
So
Yes.
it's not like it's one you would have to babysit constantly. And
Thanks.
honestly, I think it's just way too out of my arena.
All right. With that being said,
Oh, go ahead. I was gonna say,
No, no,
didn't
you
they have a pretty significant large net debt position financially? So like you have to factor that in, and then unless you don't
Mark, woof.
consider the you can hear that through the door.
Yeah, it's all good.
Never mind. This is saying a lot of funky stuff that makes. Oh no, net debt. No, they have a net cash position. Never mind.
Yeah.
Erase what I said.
Yeah, I was gonna say their debt should be offset by their book, right? Pretty much.
Yeah.
well, they
Well,
recently
I wouldn't consider
were
either of
able-
those theirs.
Mhm.
Yeah.
Anyways, we can move on.
All right.
Can-
So that was a fun little game we played at the end. Now, the next topic that we're going to be discussing is PayPal. Dan loves this one. PayPal. PayPal's earnings tomorrow. So tomorrow's a big day for PayPal shareholders and Amazon shareholders, which we'll talk about Amazon later. But PayPal actually rallying after hours 1.27%. there is something to be said about PayPal. I'll talk about it after as we get into this, but the valuation. What do you guys think going into earnings? Cheap? Could be cheaper? Should be cheaper?
I have I guess I have a question
Uh-huh.
that will lead into my answer. Is why did Adyen sell off recently?
All right. I was gonna
Wh-
save
wh-
that point.
Oh,
I was waiting. Dang it.
But if Adyen is a canary in the coal mine, which it may or may not be, it could be indicative of what might happen to PayPal tomorrow. Now with Adyen, it was more so about their take rates. The take rates started to decline. That spooked markets, but we were talking about in the club actually just before getting on here, and I listened through the Adyen earnings report. Adyen's great business, and I want to reaffirm my point about PayPal having Braintree, which I think is an exciting business, but exciting for what it is. There is a fintech we can talk to towards the end of the stream that is the true king fintech. But yeah, PayPal, if Adyen's earnings report is a canary in the coal mine or ends up being, I would not be surprised if market also kind of gets spooked. But the thing is, I think the setup is a lot more favorable on PayPal side than it was Adyen's. I'm going to give PayPal that. PayPal shareholders, I'll throw you the bone. The setup here, if something sort of changes positively, let's say the take rate is actually not as bad as what people think, or it didn't decline as much as people think. Because by the way, a decline here is not a bad thing. It just means Braintree is growing. Then, yeah. So answering your question, because I almost skipped over it by accident. Adyen's take rate declined. And I'll try to find the chart here because we were just discussing this. So hopefully I can find it fast.
while he's doing that, Jesse, I'm really excited that you're here because there's a company I want to talk to you about that had earnings recently. I didn't think I'd get to talk to you about. I'm excited too.
Let's do it. Cool.
it?
That'll be good.
What?
Is it what it
Boom.
is?
I don't know. I highly doubt it's who you think it is.
Oh, okay. Well, to answer your question, this is what people were worried about. Or it's what spooked people.
Isn't PayPal's take rate chart similar?
Yes, well, but it just guides it's still like a race to the bottom, it seems, because what's happening here, kind of cutting through the fat here and getting you right to the point, Adyen's customers are growing. And as their customers grow, they demand certain discounts. They say, whoa, you were charging us this much per transaction before. We grew a lot more. We're getting a lot of volume through you, right? We're valuable to you. We understand that. Lower the take rate. And Adyen's like, sure thing. Because on a nominal basis, they're going to be making more money. But on a per transaction basis, they're going to be making less money. So that's kind of the spook here. And so if you're long Adyen, I don't really see it too much of an issue. You should be expecting that the take rate, if their clients are truly experiencing success or they're getting really big clients, that could be another reason. They land a huge client that has, I'm going to say hypothetically, the scale or size of something like a Walmart or a Costco, which is not the case. But let's say they're trying to picture that. Costco and Walmart can almost throw you around and say, we tell you what take rate you're going to get. Because, I mean, you'll fight for that.
This is the same situation as the bank. It's just like, it's the same product. I mean, I could be wrong. Maybe there's like a big differentiation between Adyen and Stripe and PayPal. But like, at the end of the day, they're back-end processing. So I don't know.
The tools that they offer,
Do we know, with their charges on their take rate with their customers, is it tiered?
As in, like, how much you put in terms of how much volume?
Yeah, like if you do X volume, it's this, Y, this, and probably tiered down to like a certain point, and then probably flat rate after that.
Yes, we don't get clarity into Adyen's structure. I think Stripe has one on my end, but yeah, That's pretty standard. But then I think additionally, some of the bigger clients, they get some sort of like custom take rate. So that's kind of what's to be expected. In theory, if your clients are growing, you're getting big clients, which is not a bad thing. Your weighted average take rate is going to decline. So we'll see what happens tomorrow with PayPal's earnings. I'll just pass it over to the panel and say, what do you guys think? You guys think before we go talk into the next topic, what do you guys think for PayPal's earnings tomorrow?
I like the setup a lot more than SoFi.
All right.
Oh,
all
yeah.
right, right. So
There we go.
all right. First and foremost, for me, price of not for me. It's just that we've already been here before. Like if you look at last year or last quarter, the share price of where it is now is granted a little higher, sure, but like yes, and the setup then was roughly the same setup as now. They guided disappointingly. I didn't think it could drop much more off of that, but it did. And what was the setup for last one? Also, quote, shock the world. Anyone remember that one? So I'm inclined to say setup should be comparable to last one. What happens, I don't know. I wouldn't be shocked either way.
I'm gonna. Well,
Still not for me.
I think it's very possible. This is management's second quarter, right?
Yeah.
Very common. And I would imagine, I would hope this new CEO's got someone that he's talking to that's helping him, like some kind of consultant or something that's saying, hey, first quarter, basically give yourself a layup for the next 2-3 quarters. Like give such a poor guidance, that you can hit and then raise, I would hope. Because basically if you come into a company, you're a new CEO, that quarter, nothing is your fault. Everything's going to be the fault of prior management. So you set low expectations so that you can at least set yourself up to like beat and raise and be like, yeah, look, we're doing so good. So I would hope that's what's going on. If that isn't happening, I don't know. It'll be interesting.
yeah.
I'll tell you what I think. I have no clue. I find this business so boring. I have made my mistakes with buying commoditized businesses that trade at, that act as tech companies that I don't get into them. And I think that's what these are.
I agree. Like, yeah, my stance on this has always been there's so much more out there that's more interesting than PayPal. Yeah, I get it. It looks cheap and all that, blah, blah, blah. But
It's not even that cheap. Like
I thought it was like 10 times earnings, isn't it?
Was. Now it's not.
Like right now, it's not. I mean, it's cheaper. It's definitely re-rated, and I think that would be like the bullish stance on it going into earnings or going over like a certain time period is that maybe sentiment got like overly bearish on it, and they're actually going to normalize at a better rate, and it re-rated too far down. I don't. If you got like a perception shift, that could be really good for it. But also like, nah. It's kind of where I'm at with it. Just nah. It could stay. I think it could stay pretty negative for a while.
Yeah. All right.
Dan, any thoughts on Grandpa's FinTech? Nope.
It's such
Oh,
a
what do you think?
boring, unimpressive business. I don't see what would get it exciting. I don't know.
Okay. I have a question.
Maybe they'll
for
say
the
AI a ton of
panel.
times, right?
If you're PayPal, buybacks or dividends?
Ooh. Good question.
What's the current
Spin off.
Spin off.
Yeah, Braintree. Like,
Well, the company's worthless.
yes. Just give
what
people
is the-
Braintree.
What's the multiple of companies currently at?
Let me see.
Can I go with like the curveball answer, which is
It's a PE of 17.
my answer is I pray to God you have something to invest in that's better than that.
Am I seeing
Yeah.
this right? They're projecting
That's
year on
true.
year 4% growth. Is that the estimate?
I'm getting a 7.7%.
That's the estimate for tomorrow. That the revenue comes in at 7%. Sorry, yeah, 6.8. I said 7.
Oh, I see that. Okay, yeah, 6 point. Okay, thanks. God,
Yeah.
To bet on a company that can't, it's growing at like 6%. It's just so damn boring.
I don't know. That's like
They do the checkout, the branded checkout button. Maybe they could announce something with Temu that would give them some excitement, because they do the branded checkout with them. I don't know.
I think I'd say
like
buyback.
Yeah,
I
I think
think
if you're somewhat confident in your product pipeline and like the health of the company, you probably do buybacks, right? If you're not confident in your future pipeline, you probably flush that into R&D and product development. But they're already doing a decent amount of R&D and product development, so like they're taking a somewhat balanced approach, which like I'm still meh on them, but I'm like, okay, like capital allocation wise, I think they're doing like all right, I guess. Like, I don't know.
My question is, what's their net buyback been doing? Because have they also been paying a good amount of SBC?
Net buybacks have actually been fairly decent. One second, let me see if I can find it.
So it's I have 2.6% on the 1 year.
Yeah, that sounds about right.
6.8 on the 3 year, 7 on the 5, 9 on the 10. They've been buying back shares for a while then.
yeah, they've had a pretty like decent buyback plan in place.
Look, it's doing so well for them.
I mean, I'm thinking about it. If you
it's a period of dividends.
If they could,
I mean, if they're right, you know, and the market eventually realizes that they're right as far as their pipeline, it could be good.
Yeah.
So,
but anyways, I'm getting bored. You guys have anything else?
Yes. No. We were just 20 seconds early on the next topic, so we can go ahead and switch, and I can kind of try to talk a little bit longer until we get to that one.
No, that's arbitrary. That is so arbitrary.
No, well, you're helping me out now by doing it, because we're just about to get to the next topic, and the next topic is actually really interesting and near and dear to my heart, and that topic is Amazon. All right, so Amazon earnings tomorrow. All right, so we made it exactly on time. Look at that. All right, so we got a couple key points that I'm going to be focused on, and then I'd love to hear the panel's focus points here. But Amazon, really big position. I'm going to be paying attention to how ads come in, and everyone's going to be paying attention to AWS, which I am sort of like nervous about. I don't know why. So, yeah, you don't blame me? Oh, no.
I don't blame you.
So, yeah, AWS, if that business line comes in weak, then, there are some things that kind of make me a little bit, worried's a strong word. There has to be something for like less word. Moderately concerned, or my eyebrows a little raised when I'm looking at AWS is, of course, Andrew Jassy and team sort of came out last year and said towards the very end of last year and the beginning of this year too, talking about how they're going to focus on AWS now. It's like, well, maybe I'm thinking too much into it. Maybe I'm thinking that they're seeing the figures and they're like, oh, that's not good. Everyone's talking about Azure, Microsoft Cloud growth, AI tools, plugins, all that jazz, and maybe AWS isn't bringing out the guns yet, but I don't know. So we'll have to see tomorrow. I'd love to hear the panelist conversation on that. I guess we'll go Jesse, because I think you were saying I should, or you don't blame me.
No, I don't blame you, because like when we look like comparatively between Azure and AWS over the last like several quarters, Microsoft has been gaining, I would say, like relative like strength in that segment. And if that continues, I think eventually like that could potentially be a point that the market kind of tips on. And we might get a little bit of a scare off of any type of like drastic decel or lag in cloud compared to like Microsoft. So if the trend continues and if the market is like, oh wait, we need to re-rate Amazon to having, you know, potentially a like not superior product in cloud when compared to Azure, things get interesting. So that's what I'm thinking.
All right. Yeah. I have a question for you on Azure though, because to my understanding, Microsoft, they don't break it out, right? They just do Microsoft Cloud, correct?
I thought they did.
They do break out Azure?
I think I had to do some finagling, or maybe I was just looking at cloud. But cloud still, I don't think cloud included like Microsoft 365 products and stuff. So it was like still somewhat broken out. I don't know. I'll look and see.
Let's see the press release here. If I see cloud.
Be sure while there's some downtime and people are looking, be sure to like, comment, and subscribe.
Oh, thank you, Bacon. Yes.
Yeah,
yes.
you're welcome.
Make sure to do that.
Yeah, and heart and share it on Twitter and Twitch ? I don't know if you're streaming.
I'm on the press release. Oh, let me zoom in. I'm sorry.
Andrew, that name. You will pick any name but 2 accountants, 1 gap.
I'll make it 2 accountants, 1 gap. I don't mind.
Yeah, you can kind of decipher it. Well, what did you find in the press release? Because I'm looking at the 10K or the 10K.
So I see Office Commercial Cloud, Office Consumer Product and Cloud, Dynamic Products and Cloud Services. But if you're looking at revenue breakdown, it was just where's the cloud? Yeah, right here. This quarter, Microsoft Cloud revenue. That's all they say.
Yeah, but so look at server products and cloud services. Revenue increased 24%, driven by Azure. Other cloud services revenue growth of 31%. So if you go into the revenue breakdown, they actually have it broken down into server products and cloud services, and then Office products and cloud services. So when I'm thinking Azure, like SMB or enterprise cloud services, I'm thinking like server products and cloud services. And that's remained like really, really strong.
So we had a total growth of 21%. Am I reading this correct? An intelligent cloud.
Yeah, total growth of 21%.
Azure right there.
Azure had growth of 31%.
Yes.
Azure, but here's the thing: Azure and other cloud services.
Yes.
Other could just be like the catch-all for like some tiny little add-ons.
So I imagine it's like vast majority Azure. I just don't know why they don't separate Azure.
Why they don't just say it.
That's what my only gripe is with this amazing business. But whatever.
Do they break out CyberSec on this and how Good Defender is doing?
Are you trying to be cynical with them? Are you trying to offend them? Are you trying to do a little stab? little poke? Like what is that?
Pokey poke.
I mean, I'm kind of curious to see like what that looks like, but I don't think they break that out. And
all right, so if they report material weakness to this, I think that narrative is gonna really kick Amazon in the nuts tomorrow.
Yeah,
isn't Amazon exposed to a different like part of the economy almost? Isn't Amazon primarily or like vastly more exposed to startup VC cos? Yeah, hasn't that been what's been like hurting them versus enterprise, which is
Well, there's also the other. Okay, well, one thing that remember the conversation we had with Prisley. You remember that? What he was saying, that's his theory, and why you're probably going to have still continued runway for all of them because everyone's going to have. Anyways, we won't get into that here, but I feel like that's something that's later down the line. But in the near term, we have someone commenting. Eric Wu says, intelligent cloud server products and cloud services, including Azure and other services, SQL Server, line and client access, calls, Nuance, and GitHub. Okay.
You guys are missing the big thing tomorrow. The only thing that matters.
Is there a cabinet company tomorrow or something?
No, when Amazon declares their first dividend.
Oh, yes. Yes.
It's going to go up. That's all that matters.
People,
even if AWS is down.
People are going to be so mad if they don't.
Only one
I won't
way,
be there, but that will be something. I never in my wildest dreams thought that I would own Amazon and then get a dividend from Amazon. At least
billion reshare or share repurchase with a dividend. Yeah.
Oh, you're predicting 23 bill?
No, I don't know yet.
Oh.
He's like a trillion.
No. That's oddly specific. I'd be like, Dan, do you have insider information?
Watch, he's only off by like $500 million.
Yeah, that's oddly specific. $23 billion, 400 million, and 72 cents. That's how much you're spending on share repurchases. But okay, so I think everything else though with Amazon, I think that ads, I don't think anyone on this panel, unless you do disagree with this, but I think ads are going to come in really strong. I think retail is going to come in relatively strong. Third party growth is going to be really strong. So across the board, the only one I am frankly concerned about is AWS. That's it.
Is this the first quarter of the price or the ad increase or the ads put in the premium content?
Yeah.
Right? This is the first quarter of that. Okay.
Yep. Correct. Yeah.
So that's going to be good.
Yes. Yeah. And the ads business, I mean, really high margin contribution. So yeah, strong contribution margin on that business. AWS showing weakness, but that could be time to step back, see if there's an opportunity to add more. But if they really beat on all expectations that I have, then there's no reason to not reward. If they show really strong, like for example, if AWS comes out and it was really strong, oh, here we go. So
we're all hack frauds. We're washed. What's the over?
I kind of hope
them saying AI.
I kind of hope the AWS report is horrible and it crashes and I can buy more.
Yes, a part of me wishes for that as well.
And like,
but,
am I right? Fallout's the number 1 or 2 show right now streaming.
yes.
Really?
number two.
Yes.
A certain someone I know.
Maybe that's a free show for people to come in, right, and see what they have to offer.
Yep.
Again, they're one of the top. If you count, depending on what month or quarter you're looking at, they're either beating Hulu or they're just under Hulu. And Hulu is the only one that's under Netflix.
They're going to get a big
but
MVD
Hulu
deal,
doesn't even count as like Hulu's more like live stuff, isn't it?
No. There is a lot of no.
Dude,
there's a fair amount.
Hulu's trash. I like walk in to
But Shogun.
No, he didn't like Shogun. He didn't like Shogun.
Listen.
You're unpopular.
Linda, listen.
What? Oh,
Stock
okay.
face,
That
pod
doesn't
face.
have to do why. It has nothing to do with why Hulu's trash. You guys want to let me talk? I like walk in.
no,
Because
Mariko is a treasure. What are you talking about?
Okay, if you'll
Just
just shut up
sacrifice
and
yourself.
let me make a point. Because I pay good money. Okay, I'm gonna give you a boomer take right now because I'm gonna tell you I pay good money for this. I pay good money for Hulu, and I walk in. My wife's watching a show, and then it goes to a 5-minute ad break on a streaming service. I'm like, okay, this is officially trash. Why do we have this?
What? You're paying for the wrong
because you
version
chose
of
the
it.
ad
Wait, you don't-
tier.
You don't have
you have
the ad free here.
You don't have the ad
Sorry,
free.
Brokey. What are you doing?
Oh my
Yeah.
god. I can't wait.
Please note, I don't watch shows.
Yeah, that's like signing up for Amazon Prime beef tier.
No, he's right. No,
Amazon Prime.
Hulu's ads are like very aggressive. How many they throw in a show?
How much more
It's like
expensive
minutes.
is-
It's like a minute and a half or two.
It's like-
No, it was literally
Wow,
440.
we are so
I-
spoiled. Back in my day, I remember. Well, it's funny. I think I'm the youngest one.
No, let
But
me
back
ask
in
you, how
y'all's
much more
day
expensive
and
is the
my
ad-free
day.
versus ad-supported?
I do the triple package
couple
ad free. It's $25 now. So
Oh,
I don't
for
know,
Disney
single.
Plus, Hulu, and ESPN.
yeah,
Yeah, you see, that's why I might re-enter. Well, that's not the reason why, but I might re-enter Disney. By the way,
Spoiler alert.
spoiler alert.
okay.
Yeah, I can say that publicly.
I don't care.
No. I genuinely want to. I'm gonna own it.
You
No,
should
you're
write
gonna
them.
own
too.
it.
Tell them to release cruise information separate from the parks. Write them a letter.
I'll write them a letter, just like the BTI.
I think you
management.
get a huge upside on the stock if they showed that. But
Well, maybe I don't want the upside until I'm done buying.
yeah.
What's
Imagine
the-
them come out and be like, we're basically like 98% booked for like 2-3 years on all our cruises. And then show the margin what they're getting.
Bro, they make so much money on cruise. They make so much
You
money.
know, they bought boats during
Yes.
lockdown when other cruise lines bailed on some of the boats in construction in Europe. Disney came in and swooped in and got a discount on some of them.
Can we talk about this for a second? Because I just went on one of these cruises. Not Disney. But can we talk
Yeah,
about
just
cruises for a
in
second?
general. Yeah. Why
Can you
not?
tell us which one you went on? Because I think that's the one that's the
Royal.
best run. Yeah, that's the best managed cruise line.
It's also like
Ooh.
supposedly like the higher quality. Just as like if you're going to cruise, I guess, is my understanding. I
That's
don't
what
know.
I
It's the
did.
only one I've
I've
ever done.
Yeah.
Fabio.
But wow, Jesse. Okay, fine.
Sorry.
It's okay. I'm
Sorry,
muting my.
no. I'm back on Azure and AWS. Do you know when AWS started really working on building out NVIDIA clusters?
No, I imagine it's going to be like mind blowing.
Okay, so here might be another thing to be cautious about. Is that from just
Oh,
my
no.
preliminary Googling, Microsoft. Oh, thank God he's gone. No, okay.
Whoa.
Microsoft. Let's go. No, Microsoft started building out their AI clusters, their NVIDIA AI clusters in late 2022.
Mm-hmm.
AWS just announced their partnership with NVIDIA. So they might be trying to catch up like crazy right now. When it comes specifically to NVIDIA AI clusters. I'm trying to verify that. But it looks like a lot of their current AI clusters and the products they offer to their customers are kind of in-house and not NVIDIA GPU based. So we could see potentially Microsoft's growth coming from that AI segment because they're getting a lot of it.
Oh my God. And that like, oh no, you know what? Okay, so now I'm a little more worried by Jesse's commentary. Jesse.
It's actually Soft J. Yasi.
Because if he did have that commentary of being like, oh yeah, well we need to focus on it, they could have realized that they missed the train by 9 months or a year, and they need to really pump out these NVIDIA AI clusters because they didn't have that offering, and everybody was using Azure for it. Because a lot of SMEs, they're not going to build their own. They're gonna consume it as a product, a cloud product.
The silence is deafening. Can you hear it?
When did they announce it exactly? The partnership?
Microsoft and NVIDIA announced their partnership in late 2022.
Mhm.
AWS and NVIDIA announced their partnership in late 2023.
Oh, so they've been
So about a year.
And presumably before that, Amazon's been all in-house with their AI clusters.
Maybe
and
not
so
all
it's-
in-house, but they definitely, it doesn't seem like they were pushing NVIDIA specific GPU clusters.
It's not for certain. We will see tomorrow. We'll probably see tomorrow, but
I'm just saying, if we see that deviation, right? If we see Amazon or like Azure just reported amazing numbers and Amazon's AWS is kind of lacking, that's probably where it's coming from.
AI services products. Okay. All right.
I feel like you guys are fretting over like what's ultimately going to be a footnote over the next 2 years.
Yes, but it can lead to opportunity.
Yeah, it could lead to a big buying.
That's what I'm trying to say, right? Like if we have an overblown sell-off because of 1 week segment of Amazon and ads and everything else looks really solid, and we expect it to be like just a delay in them getting caught back up, then yeah, it could lead to overreaction.
Yeah. And by the way, we spilled over into it, but this is so related, and that's data centers. So we're already in the data center timestamp. So hey, have at it. But data centers, I bought actually more, thankfully, and the earnings came out for Vertiv, but VRT. How do you feel about it, Andrew? The floor is yours.
Talk about
Jesse,
cruises.
can you go on mute? Oh, thank you, Jesse. Just messing. I actually wanted to talk to Jesse about something else.
Go for it.
I did want to talk to him about Atlassian because they reported and got crushed.
Team. Okay. They got crushed. Okay. Yeah. All right. What happened here? What crushed? Wait, was it today?
No.
Okay, here it is. Yeah, well, it's 177. All right. What happened?
Thanks, Dan.
I honestly am not sure, but I wanted to talk because we've brought up because I just started looking at. Obviously, I was on vacation, didn't have like a ton of time to go through exactly what happened. But I mean, over the past, like, they have not had a good year so far this year. It looks like people might be worried about like, because they're Jira. So, which I think a lot of people that work in tech would know. Still looking expensive, but like getting closer maybe to being attractive. And so I guess my question for like Jesse is like, I don't know if there's been a deterioration in how the company's performing or not. I mean, it looks like I did some like quick math. Looks like there's still above a 30% year-over-year growth rate top line this quarter. Yeah. See, Carl's saying they're Jira plus Bitbucket plus Confluence. I don't know Confluence, or I've heard of Confluence.
Okay, so and I'll point this back to over the last year. I think me and you have talked about this previously, but a lot of companies, a lot of like SMBs, SMEs, were going through like high scrutiny of their SaaS spend, right?
Mm-hmm.
And they were auditing a lot of their SaaS services and ripping out licensing, extra licensing that they didn't need for certain SaaS services. And I think they were doing the same thing with kind of compute space and cloud too, right? Azure and AWS. Mm-hmm. So most likely, I mean, it would be interesting. I would have to dig into it more and listen to their earnings and whatnot. But it could be that, their growth still looks pretty good. I wonder if they give bad guidance or something.
I'm thinking it must have been bad guidance. Which could be a canary in the coal mine if you're thinking on the same thing for HCMs. I don't know if you are.
Yeah. This is such a hard one because it's one of those that's already like priced for like extensive long double-digit growth, and any like break in the narrative gets you kind of like
But I mean, like, it's
Flushed
down
down
quite a
quick.
bit from like the 150x free cash flow multiple back in 2021. You know,
Oh yeah, but like,
I'm just,
but
I'm obviously being a little facetious. Yeah.
I mean, I think when we talked about it previously, we are like, like, was it 150 or so? Was kind of interesting. I want to say it was like between 130 and
150,
150. I don't know.
somewhere between 130 and 150. I wanted to say 140.
Yeah.
So maybe,
Yeah.
That's
but
the
like
price
that
of
also,
YouTube. Yeah.
also though, but if this company, like for example, just hovers between 170, 200 for a year, then after a year or two, it might get interesting again. Who knows?
Oh yeah.
Because
No, for sure.
then fundamentals catch up.
Yeah. And if they are going through a weak guide period, which I would expect that almost to be over by now. So it would scare me if they're guiding weak now, because I would have expected that all the weak performance would probably be in the rearview mirror as all the SMBs and SMEs consolidated their licensing into their like SaaS audits. So that would concern me, but it would be a very interesting one to keep an eye on. I don't know what's their. I mean, they're probably still in the state where like their R&D is going to be absolutely insane, right?
Oh, I'm sure.
Yeah, so they've got good free cash flow, but their R&D is probably going to be nuts.
Oh, wait a minute. So their guide for the next quarter looks like they are a. Are they a June year end? June 30 year end? Is that what they are? Or March year end? No, they're a June. Sorry, I'm just looking at this now. Yeah, they're a June year end. So they are guiding. Huh, that's interesting. I'd have to understand, because I would think that this is a company that is fairly consistent with its growth. Like it should be subscription based, right? They're guiding for a Q over Q decel, or I'm sorry, not decel, decline.
So they're guiding a Q over Q decline, and they didn't cite. Did they cite like?
I don't know.
Did they just come out of their year end?
Their year end is June 30th.
Oh, it's June.
So they're guiding for 1.12 to 1.13 million in revenue. Oh, but we will no longer recognize server revenue, and therefore expect server revenue to be 0. That's
good.
What was
Good.
server revenue in the current quarter?
I think they had legacy deployments for some of the places that were like server licensing, and they were going to all cloud based, if I remember correctly.
Mm-hmm.
So then they would eventually, as they would migrate everybody off of like hardware, their server hardware, or like on-site DC servers that are ran like at the actual enterprise, they'd basically just be in their cloud environment. So it could be that. I'm pulling that kind of out of thin air though, because that's just kind of what I recollect off the top of my head.
Yeah, I don't know. So, anyways, we'd have to look at more, but just something like wanted to see what you thought about it, because it's I think an interesting company if you can get it at the right price. Potentially, if the market discounts it enough.
The products of theirs that I've used, I've liked a lot.
Every software developer in the club says they use Atlassian products.
Yeah,
and everywhere they go,
their products a lot.
Not to like torpedo the thing, just to put it on the radar. You did get a thingy thing.
We're going to talk about that at the last segment. I saw it, Fuhat, but stay for the last segment. We'll go over it.
Okay.
All right.
So Vertiv.
Yeah, data centers.
Yeah,
data centers.
Vertiv's included in that. So we're actually 10 minutes early. So let me actually change it to 30. Okay. No, I'm just keeping the timestamp. All right, data centers. So the trade, how's it going? How's it going where we are now?
With data centers in general?
Yes.
I think we're in inning number 3,
The third
and
inning.
it's going very well.
So let's review. Alphabet. They said what?
They're going to spend more on
Meta.
How much
And more.
more?
Meta. They said what?
They're going to spend more. They
Spend
gave a
more.
number. It's like, but a lot.
Yeah, they,
Microsoft. They said what?
Say they're going to spend more. I didn't know. I don't know.
Yes.
Yeah.
Everyone's going to spend more.
Oracle.
Who gives a shit about Oracle?
Hey.
They have a hyperscaler.
Hey,
Come
man.
on.
No.
They're the one that's building like the largest DC in America, right?
I thought that was Microsoft.
No.
That's the Oracle? Oh, shit.
Oracle's AI DC is supposed to be absolutely insanely large.
Oh,
I'm ignoring
see?
them. They did financial engineering on their stock. I wouldn't even look at them. They
I know
borrowed
it's the one.
like that.
They have a huge DC build in the pipeline, and it's literally dedicated to nothing but AI compute. And that's why Arista reacted so well off the news of their partnership.
And so, wait, Arista reacted well to the news of what partnership?
Arista like released a PR with Oracle a while ago, several months ago, I think, if not quarters. But the speculation is that Oracle would be using at least partly Arista and other Ethernet, AI Ethernet switching providers for their ROC version 2 AI clusters.
Okay, so we have then Oracle spending more money.
Okay.
I'll include them.
Do we include, is Alibaba spending more money?
Or I could draw the line. All right. The reason why I didn't want to include Oracle is because I hate them for financial engineering.
Okay.
I hate them for that.
Well, wouldn't that make sense? Because they're like a financial accounting system, so they know how to engineer financial systems. So.
No. They just, haha. They borrow tons of money to buy back stock. It's
Oh,
like,
for 2. Let's go.
They have the worst balance sheet of their competitors. So terrible. Terrible.
Okay, so no, I think that the CapEx spend is there's still so much going on here. Remember, if you have a company, Vertiv, that's exposed internationally to data center spend, you really benefit because all of this CapEx right now is going in primarily into the US. And companies have said, because the way, and Jesse can give you like a more in-depth good answer on why, but like for the speed of your LLMs and actual response time, you need to have, or you want to have data centers close to where people are. And so they will need not to spend as much money, but they will need to spend money to expand to the Asian, South American, European, all those African, all those markets. And so that's why Vertiv, for example, their bookings growth was 60%. I want to say it was year over year. For anyone that wants to know, buy side had 30% as what they were wanting. That's buy side, not sell side. So like, insane bookings growth. Just really, really solid. Sterling is another one that I have that will benefit from this. Saying, and when Sterling, who was the one? It wasn't Meta. What were they selling off from? Both of these, maybe it was just like a little bit of worriedness before earnings. But I was saying, like, I would have bought Sterling probably a little bit back, but I actually think I threw it at Vertiv, which ended up being the better buy right before I left. I don't know. I mean, I'm still very bullish on all this, which may be a top signal. So maybe you should all just sell up and run for the hills.
No, definitely not.
I guess the only other name that's like somewhat in this space besides Vertiv and like the actual builders would be what, like Digital Bridge, or is that a Digital Bridge too far?
Digital Bridge. No, I don't think they benefit because the people that are spending money on the data centers are people that Digital Bridge can't get in.
Okay.
You can't invest into Amazon as a Digital Bridge. You can't invest into Google. And I think Dom's talks, we can talk about this. I think he brings up a good point that I think there's an interesting counter to regarding the ROI and data center spends.
There's a section I want to meta, but
okay, then we'll talk about that later. We'll just
because
Put a pin
Dom,
in it.
we'll
it
cover
needs
that
to be
later.
destroyed. But anyways, Vertiv.
Okay, so, well,
What do
they're just.
What do you like about the opportunity?
Lock it.
What'd you say?
I said I like it. I like it a lot.
So one of the things that's cool, so like people worry about NVIDIA as an example because NVIDIA is in a sexy enough part of the market that people are going to start going for their head, right? Like Amazon, Google, you could even say Apple. I'm surprised. I guess Apple can't, but I'm surprised Apple isn't trying to build out data centers even at some point. And like, it just seems like there's such an arm. I know they're not a hyperscaler. I know they don't have that, but like for their own internal processing. But that's another.
I wouldn't be surprised if it's coming.
Yeah.
Do they use a hyperscaler? I thought they had their own DCs.
But
they have to
put out more.
I was gonna say like
because they have their own cloud business. Yeah.
Full. They couldn't be full hyperscale. That'd be like insane for them.
Right. And so they're going to have to start increasing CapEx too, I would think,
Yes.
with DCs, wouldn't they?
Yes, I was hoping we were
Like-
going to go there.
Like not as, I mean, okay, you gotta think for a second. Nowhere near as much as a DC, as a hyperscaler, but it's going to be like material, I think.
It depends.
Okay. Please explain.
Because if they get into the AI game, it's going to be massive. Right.
Okay, so it's either
like
a decent amount or massive. I like this.
No, but like the majority of growth right now in the DC space is coming from AI compute, right?
Right.
If Apple has some type of initiatives where they need to build AI clusters, they have the money to basically do whatever they want. So, and those will be net new builds in a pretty large fashion.
Sorry, I'm not trying to cover just. No, so that's another potential and potential company that could get into this. So I like. There's a couple things. One also is these new NVIDIA bands, or I should say first with Vertiv. One of the really big opportunities with them is they do a lot of things with energy conversion into these data centers. So one of the things with data centers is there's an energy problem, both with the grid. At least people say that. Some people say maybe, maybe not. Doesn't matter because I'm not playing that. What I am playing is the energy conversion and cooling of these. So Vertiv does that. They do the bringing the power from the grid into the data center and converting it, so that your machines can run on it. They also do the liquid cooling, which is really, really massive. That's a really big opportunity because especially I think it's H100s and 200s use an insane amount need an insane amount of liquid cooling. And only 10% of data centers are retrofitted to do this. Maybe it's up to like 12% now, who knows, but roughly 10%. So you have this company that's not in a sexy enough industry that someone's going to come and try to take it. Like Microsoft isn't like, hey, let's make our own liquid cooling. Like it's a footnote for them. But for a company like them, it is large enough and big enough of a deal that's they can make so much money off of this. And then you also have they're internationally exposed. They can make money in Europe. They can make money in Japan or wherever else people put DCs. And so, yeah, so we'll get into like why these companies need their own AI infrastructure. But I think that these guys making the money on the CapEx spend, and like, regardless if you think AI itself is like, what's the word? Like, not a facade, but the ROI isn't there. The ROI is very much there for you to make money off of 150 to 200 billion in CapEx spend a year for the next few years. Like, it's there. So but I don't know if other people have thoughts on the speaking.
Well, I'm not going to rehash what you said about Vertiv. I'm biased in agreeing with you. I have money in Vertiv and money in Sterling. I think I have more money in Sterling than Vertiv, and that's been a mistake. Vertiv's been doing really well, and you already addressed the liquid cooling opportunity, how to, let's call it the upgrade cycle for existing data centers. But yeah, I like the space, and I think, yeah, I like what you said. We're in the third inning. Valuation on Sterling makes more sense to me. Vertiv's, I think, is sort of like, it's probably going to grow, and it's probably going to grow well above sell side. But you got to admit, like, if you take sell side's estimates as fact, it's you're paying.
Sell side's way short, I think.
Yeah. If sell side's short, you buy more. If sell side is on point, oof.
No, I don't think sell side's close to on point.
Yeah.
I mean, they raised, what was their, because they had raised guidance quite a bit. I want to say from 10 to 12% sales growth, and then expanding margins. Like
we'll address Dom's recent argument, or talk. That's not AI. That's a LLM, large language model. What you're talking about, we'll talk about like more. What some people would say is more. What we can point to as AI. AI in the context of conversation is used interchangeably with an LLM. An LLM is what you can touch and experience, but we'll talk about AI in a sec. We get some meta.
Go read Jassy's letter. Might be helpful.
Yeah. So we're roughly 7 minutes left on data centers. If there's any other business we wanted to get into, I think with Sterling, I don't know if we covered Sterling in depth, because Sterling has a lot of things going for it. Besides data center build out, you also have the infrastructure play, right?
Yeah.
So adjacent to it, why I like Sterling as a business, you get exposure to data center infrastructure build outs. And well, I don't want to leave out the other giant in the room. I'm looking at Jesse. I'm reminded of it. Jesse's very familiar with this business, and that's Arista Networks. I don't want to leave them out. They shouldn't be left out. This is a serious powerhouse, and they're getting their ass kicked by Cisco. Jokes.
Yes, they're trash.
They're trash.
Absolute trash.
And you already mentioned them with Oracle project. That Oracle project's, well, that's already in the cards. But how do you feel about their guide for Q4 sandbagging?
I think they're guiding what they know, right? I think they guided what they basically could guarantee, and even the commentary was like, actually not for Q4, or well, their 24 guide was basically what they knew they could do, and even analysts were like, well, if you're expecting to potentially hit this number here and this number here, that's like your guide, and they're like, yeah, we think we can get there multiple ways. So I think the guide was pretty soft. And if they do end up landing some of these larger AI cluster Ethernet builds, those could really ramp up pretty quick. So how I'm thinking of what they guided is that they probably guided for what they could guarantee. And most likely the commentary that we're seeing from Microsoft, Meta, Oracle, all about increased DC spend is going to trickle down to them in some way or another. It's like TBD on how much of that they will get, but for a lot of these AI builds, if Meta does continue to push out and really adopt the ROC v2 over InfiniBand, then that's going to be a pretty big tailwind for them along with just their enterprise offerings kind of starting to take up. So I think there are multiple ways that they could easily meet that guide. But we'll see what happens.
I also shareholder, but I'm not there at the allocation yet, but I want to get there with Arista. That recent pullback we saw, which to be fair, when I threw out that number in the club, I was almost like throwing out of my ass in terms of like the timing. I had no idea we would get there. I didn't have the let's call it the reaction time to really buy a bunch of shares.
My lowest buy order that went through was 240.46.
Yeah, you got a better buy order than me. I got like mid 240.
And mine was like 242.
While you were gone. That's the
no, and I've been averaging up on this company since like 119. So
yeah.
As my conviction has grown, and actually I was trying to evaluate if I should be looking at selling it, and then I saw that there was pretty much a pretty large technological shift, and that the pipe dream of Ethernet taking over InfiniBand wasn't actually that much of a pipe dream. It was actually already happening. Meta's already doing it. And they released some engineering articles and some presentations on their Ethernet AI clusters. And after I saw that, I was like, okay, it's time to definitely hold and maybe add a bit. So, but it could be, they have a tendency to have a weak Q1 print.
Yeah.
So with Q2, 3, and 4, usually 3 and 4 being the strongest, and a weak Q1 print and like a decent Q2 print. So if we get a weak Q1 print, you know what? It's most likely going to just depend on guidance. We'll see if the CapEx spend guidance for a lot of the big tech is going to flow down to them and they're going to raise guide. If they do, then I think that's just going to be, it's not going to matter what they report in Q1. If their guide is good and the market realizes that they're going to be getting a lot of that CapEx spend, it's going to probably pop. But, I've been saying like my point of interest on this is really probably like for me to add more is like 240s down to 200.
Yeah, now you want a little bit more of an aggressive.
Yeah, because I got a decent allocation, so.
All right, we have now the topic that Andrew wanted to talk about.
Meta ?
Meta. Oh boy. All right, and it's related to this because it kind of segues off beautifully. All right, Meta reported last week, and literally the day after the weekly call, right, I go long beta.
Well, Meta's not pure beta, to be fair.
It's not, but it was kind of funny timing. So I felt like we talked about it last live stream, but we're going to talk about it again. Let me bring up the presentation. Go ahead and share whatever you wanted to share.
Who, me? Share what I want to share?
Yeah, or what do you want to talk about with Meta's AI? I think I know what you're going to say.
I wasn't going to say anything specifically with Meta, but what I was going to say, there's there's more than two things, but 2 points I want to point out because Dom said, like, what's the point? Like, the AI ROI isn't there. And my counter to that would be you can't necessarily see the ROI all the time. AI is such a broad term, and I think it's very well. First of all, I don't think we're at AI anything yet. I think the only AI when I think about it is like Gen AI, which is basically like your AI is basically a human stuck inside a computer. And we're not close to that yet. What we have is a bunch of like advanced models. But if you think about it, what did Meta do with their AI? They found better ROAS, which is return on ad spend. So a better way to get ad spend back. They found ways to, like I said, Jassy breaks it down, but they found ways to help developers do things. They make internal things more efficient. It's not all just an LLM. The second thing is that if you think about this, you have Meta Google, Amazon, Microsoft. Those are and even Oracle. Those are the people right now that are investing in AI. And what they all have in common is more cash than they know what to do with. And so what's more terrifying to them, that they overspend $3 billion a quarter on CapEx, or even $20 billion a quarter on CapEx, or that they miss out on the AI wave and just get run over by everyone else? Like, what is a scarier like proposition?
Before,
It's
yeah.
Yeah. And so I don't think these guys are looking at it from an AI perspective necessarily. With that being said, the fact that these guys sold off because of their like slight revenue miss on the guide and their CapEx spend is so insane to me when you think about the fact that they have probably 20 billion net cash. So like, and they're going to be free cash flow positive. And I looked up historically, you go back on a 10-year trend, or a 5-year trend, mid-20s ROIC. And you'd rather have them put it in cash? Like, how stupid are you? Like, like, why are you selling here? You're an imbecile. And so, by the way, I don't hold Meta. Like, I'm looking at this like, hey, maybe it's time for me to buy.
All right.
That is not a fact.
You want to hear my argument? My
Yeah.
argument for the
Yeah.
whole, AI isn't returning anything, right?
Mhm.
Why are we not talking about IDFA anymore?
Yes, exactly.
breakdown
That's
Well,
that's
what I
my
said,
point.
ROAS. That's
Breakdown
my
that-
ROAS.
It's literally because they built out their AI recommendation and tracking
Yep.
engine stuff to make it to where IDFA doesn't even matter.
And
break
can
down that acronym.
Can I tell you that I know that I'm biased in saying this, but like the ads on Instagram are probably way better than I think the ones I get on YouTube. They're scarily more targeted.
Acronym on that one, please. Breakdown of the acronym.
IDFA.
IDFA.
It's
Identification something
Yeah.
something.
IDFA.
I don't.
It's
there's no G.
identifier for advertisers. See, the F would make you think it stands for something besides for, and you see it's ID, identifier for advertisers.
Okay, cool. Thank you.
Which was just basically Apple's way. Oh my gosh. Apple's trying to build a DSP without their own data centers. Yeah, they're going to have to build data centers for this.
Thank
for
you,
AI.
Rob H.
Because you can't have a DSP like that try to be a walled garden and you compete with these guys on the DSP or SSP side.
Yeah, so that's why we buy the ones we were mentioning before. Easy,
Mhm.
done. But on the meta argument, exactly, Jesse, right? Why aren't we talking about that? And
It's like it was such a big bearish point, and we're not even like discussing it, not even in the back of our minds now, right? Like IDFA was going to kill them. That's what the narrative was, right? Doesn't even matter.
Yep. IDFA is already great. I don't know what that comment means now. This one.
Could it be a sort of like it's already been priced in or it's already been realized? Question mark.
No, but we're making the point that when someone says the AI investment, where's the return? This is where it kind of gets into the wonky consideration of like you got to take accounting with a little bit more nuance than just on the surface. It's very difficult to attribute a contribution margin to internal investments like AI, right? Because we don't really. I'll give you an example. Another example of a business. It's away from AI, but it's kind of applying the same principles. So WhatsApp, I believe it's not a massive amount of revenue coming in from WhatsApp. But if you actually view WhatsApp for what it is, the value that it provides Meta as an enterprise is absolutely immense. And it's very difficult for someone who looks at the surface to determine that without kind of taking a bird's eye view and sort of thinking outside the box here. Because for taking a step back, Meta, in order to advertise to you, in order to provide the best advertisement possible, it needs data to synthesize and figure out what does Andrew want, what does Jesse want, what does Bacon want, what do I want. Well, WhatsApp is one of those ways in which they are able to get data and then utilize that to improve that product. So the value add that WhatsApp has to the broader family of apps is therefore sort of kind of unknown, but definitely they probably have an estimate internally without actually us having. So we look at WhatsApp. If you're just looking at the surface and you say, well, the business advertisement subscribers of what they've monetized WhatsApp at, I believe, I forget the exact figure, so I won't quote the exact figure, but they do generate a certain amount of revenue from business clients. And I think you have to have over like 500 messages on there for a business client before they start charging you. So you look at that and you say, that's the value that they're driving from WhatsApp. That's not true. So same thing with AI. It's becomes difficult to really attribute, but you can make the argument, I guess, that the management team is lying about where the improvements came in the underlying business, because the underlying business improvements did happen. That's not debatable. That part's not debatable. You can debate maybe where that improvement came from. Management's telling you it's from their AI investments. Investors might look at that and say, no, you're lying. It didn't come from that. The business just improved because of other reasons that you're not telling us. All right, you can take that stance. I think that's a stretch, if anything. So,
well, and some of the commentary that we got on this last call, I believe, was that their AI recommendation engine improved real watch time by about 10 to 12%, right?
Yes.
From the improvements in the AI recommendation engines. So like a lot of it is going to be about, keeping people on the platform. That's not going to be a line item where Meta's going to say, we made this much from AI.
Yes.
It's just going to be a line item of, hey, we made this much from advertising through family of apps. And because everybody was on our platform more, more money.
And okay, so then the question comes out. The question is, they already built out quite a bit of AI infrastructure. What's the point of building out even more? Well, our world is becoming increasingly more complex with greater and greater amounts of data, and all that data, it's a race to see who can get the let's call it better synthesization of that data at what speed as well. So quality and speed matter. And technology is advancing rapidly. So that doesn't mean that once you build out a data center, doesn't mean you just leave it and let it go. There are upgrade cycles that have to come about. And so that's also going to be clear. So this is CapEx. It's going to go on forever. That's why it's such a walled garden. That's why not everyone can do it. And that's why it really is, if you haven't really caught up to them, there's not a strong likelihood you're ever going to catch up to them. There's quite a bit of catching up to do. And that's a great benefit for the current hyperscalers. And again, that's why I loved Meta's investments in CapEx when everyone hated it back in 2022. Everyone on this panel was pretty much on the same page there. And that was like what I was so shocked by, just what the world was thinking, the investor world was thinking. They couldn't see it before their eyes. They started pulling up numbers out of their butts and making up stuff, even in some massive grand hysteria across the population of investors. But kind of getting into not really understanding why having your own internal hyperscaler is of any value to a business that, of course, has to then utilize a hyperscaler to provide you the content really made no sense to me. And that's obviously a weakness that Netflix has compared to some of their competitors like Alphabet. Another kind of point to just beat the dead horse here, to the other point. When you say Google Cloud, right? Google Cloud has a value, but what if I told you Google Cloud's value is so much more than what we see from Google Cloud profitability contribution? Well, what does Google have inside of it? Google Search, YouTube. Where do you think that's running on? So
AWS.
So question, like,
yeah,
and maybe your answer is because they just can't. But why, if I'm a Netflix, why am I running on AWS? Why am I not trying to build a plan to get my own?
Why run on AWS? Because the cost. Oh, you go, Andrew. I mean, Jesse.
So specifically for something like a Netflix, like you are looking for massive amounts of regional diversification. of
Yeah.
the servers that you're running to deliver those streams. And a lot of times you're even putting these servers inside ISPs and stuff like that to shorten the transit length between you and the end customer. So like it's one thing to build, let's say, an AIDC, right? Where you're going to be building an AIDC and you're going to build this massive thing in one location, and you're going to be able to just run your AI workloads in that one location, right? If you're providing a service to hundreds of millions of people all over the world, and you need to build in like redundancy on a geographical scale, that's really hard to do, right? When you can go to just Azure or AWS and say, hey, I want these like 80 regions, go. Like,
So it comes down to like
the lift
Netflix.
The lift on doing it is very, very hard when you're looking at like a worldwide scale.
Yep. Netflix, Disney, they can't do it. It's
How interesting is this? Is this why people are interested in Cloudflare? Because the Cloudflare has their own servers all over the world. Cloudflare claims they're the fastest out of anyone.
But Cloudflare isn't a hyperscaler, right? It's just a connection point.
Yeah.
Right?
And
I thought they were, because they have their own coding language, don't they? Which would make me think that they have their own. They're like almost like a high. Cloudflare's weird.
Cloudflare's like Fastly. No, Cloudflare's like Fastly.
Okay.
So no, you don't. I'm pretty sure it does not run independent of a hyperscaler.
Yeah, a lot of these services that are like Secure Connect are built actually. It's like Cloudflare might actually be using AWS.
Yeah.
Or Azure. And they're saying, oh, we have all these connection points around the globe, and it's because they're just using a hyperscaler.
Yes, no, that's what it is. I just looked it up. Cloudflare utilizes AWS. Andrew's like shocked. Yeah. No, this truly is like the biggest walled garden like you could imagine.
Yeah.
I still don't understand the Cloudflare thesis. That's a whole nother thing. Because I've been trying to understand what the thesis is on Cloudflare.
I haven't really, honestly, if I'm being honest, I've not looked into Cloudflare.
You don't. It's a waste of time.
Yeah, exactly. That's what I
just buy Palo Alto.
I think Peru Sexana has it. So just
yeah.
Yeah.
The if you're looking for perhaps like the tallest wall in any garden, you're looking at the hyperscalers. Like,
right.
I can't think of something that just requires such an immense amount of capital. Like, well, let me correct myself. There are businesses out there that, they probably have a higher walled garden, but they're much smaller in terms of their maximum scale they can achieve. These guys, it's pretty much just like the entirety of humanity and its interaction with the digital world. So I don't know where that ends. Yeah. Right. The opportunities are endless, right? Right now we're flirting with the idea of artificial intelligence, just at the cusp of it. And so who do we need for that? We need them. So there are no visible limits to what they can service. But getting into that game is like, good luck.
So for all these walled gardens, bullish Lowe's and Home Depot, picks and shovels.
Walled gardens.
All right, we have another top. Well, we didn't even go over this presentation. We got to go over the presentation. All right. Yeah. So, and then we'll go over to the last segment, which is troubled and boring industries. Yeah. And then we got to go over Fuhat's super chat.
What time is it? Okay. Go ahead.
All right. So advertising revenue by geography. Fuhat will be so mad if you do that to him.
Well, you super chatted. We must honor the super chat.
We must honor it. I'll stay on for you, Fuhat. Don't worry. All right, advertising revenue by user geography. I felt okay. This is nothing really stood out here besides that North America it's continuing to grow, and the overall growth is quite impressive to say the least. So you see from Q1 to Q1, from 28 to 35. Really impressive. If I'm going to spoil the story so we can kind of cut to the chase on what really happened, or we already actually discussed that, actually. Andrew brought it up. People got pissed off with the CapEx increase. Revenue by user geography, again, broken down here. Similar story there, because this was the advertising and this is total revenue. And then the segment breakdown, of course, it's all advertising. They have now the Reality Labs, which I believe Reality Labs is showing also impressive growth, but from small numbers. And the glasses, they kept saying, that's the next glasses I'm going to get. I promise you that. The next glasses I get are going to be the Ray-Bans Meta glasses, because I get additional functionality for pretty much the same price. Like when I look at the price of these versus those, pretty much the same price, additional functionality. Why not, get that? So, and I'll test it out. I'll let you guys know if it's like utterly trash. At worst, I have a gimmick. And yeah. So then going down, we also have expenses as percentage of revenue. Kind of similar story here. It's improving, and nothing really highlight there. I'm trying to, because we already went over this, so I'm trying to see if there was any points that we didn't cover in the prior conversation. Net income, also impressive growth. Again, that's not what the market was upset with. EPS growth was good. CapEx, okay, this is where everyone's like flip their shit. CapEx guide increase of about $3 billion. It's not shown here, but kind of filling in the gaps there for you. So capital expenditure is down from 2022, and this is really talking about, well, they've already built out a lot, yes, and so do they really need to build out the same aggression? Probably not, but still, you want to see that they are pushing forward with continuing CapEx in artificial intelligence, data centers, and all that jazz. And we talked about this prior to the call. Leo, one of the other analysts in Capital Mindset, he asked me, all right, if they come out and they say DC spend or infrastructure spend down, is that bullish or bearish? Bearish. I don't want to see that right now. And Andrew pointed out, yeah, with these companies who have tons of cash, you would hope that they have opportunities to continuously invest in the business. And then this is still impressive because it's still somehow growing. Like, what? So also the quality of advertisements also increased. They were getting
the world.
Yes. Yeah. That means they can get the other half. That's what that means. They get the other half.
Well, maybe the other half doesn't have like access to the internet. I don't even know.
So this is an interesting question because really I haven't penciled that out, but it is a potentiality that eventually they start to get into some commercial use cases for their hyperscaler. And some of their
they will be far more efficient. Think about that for a second, okay?
Why would they be more efficient?
Because what's AWS and Amazon and Azure doing, right? They're just building out NVIDIA clusters, which they have to, which they need to for the customer demand, right? But Meta is doing basically open source AI development, right? So they're looking at developing not only on NVIDIA but also on ARM, right? They're nixing out InfiniBand from their AI clusters. And then they're developing their own GPUs. So if they scale to that type of size and they actually are able to offer a hyperscale type of AI cloud service, it's most likely going to be a lot more cost efficient than Azure and AWS.
Isn't there so much more though to being a hyperscaler than like the AI section?
Well, and that's why that's why I'm saying you just do that. Right? Because
I see.
You don't worry if you're Meta, you don't worry about the full ecosystem development of a traditional hyperscaler and a regular server compute, right? You perfect AI and then you offer that as a service.
Yeah, and they're the only ones right now that I think they're willing to take on that risk, right? They're going their own way versus everyone else, like you said, they're going for the NVIDIA superclusters.
Yeah.
Yep.
I mean, look at them. They don't even do ARPU. It's ARP.
Well, I will say that like I think the NVIDIA clusters, everyone isn't going 100% NVIDIA clusters. A lot of the Azure like Microsoft AI clusters that are for like Microsoft AI and not Azure customer facing AI aren't fully NVIDIA, right? They also use a form of like Ethernet versus InfiniBand. But the customer facing hyperscaler offerings are a mix of NVIDIA and like kind of home, like in-house. I think what's happening is that it's super easy right now for Azure and AWS to justify building out NVIDIA clusters, because if you have the demand for it, right, you have revenue from that right away, right?
Yep.
Like it doesn't matter. You don't have, your calculation for your return on investment is pretty dang simple if you know what your demand pipeline is going to be from your customer base. But I do think there is a good chance that, if Meta does perfect their AI clusters for their own uses, in like 5-7 years, we could see them start offering AI compute as a service.
Yep. And that could be an interesting thing that I had never penciled out, and would be more in the extreme bull case. And that would imply that right now
it's
Well, if that's the case, then Fabio has to start teaching me about boxes.
I got the reference.
you will be converted, Andrew. You will join the blockhead cult.
No, it's not that.
I know,
Yeah.
but it's part of the blockhead cult.
No, it's not.
What it is that if you join and become a member, you'll find out what it is.
Wow, that
Wow, I'm shocked.
I'm shocked. But okay, so yeah, it's a very interesting question. And if they do end up doing that, which by the way, Jesse, has Mark said he's not gonna go commercial, or did he say quite the opposite?
No, okay, so like listen to the earnings call and listen to how they talk about monetizing AI.
Yeah.
And and if they're saying, hey, it's mostly going to be business monetization of AI, like improvements, but they also say eventually we see that we're going to be able to monetize this AI infrastructure, right? So like in my mind, I think it's not inevitable, but the amount that they're open sourcing their their language models and their AI infrastructure and their code bases, like I think they're setting up for it. But I think it's not going to be like what we think of in a traditional hyperscaler sense. It's going to be like what all the hyperscalers right now are trying to build out. And they're just going to show up one day and be like, hey, we got this service.
Yeah. So that would be an interesting world. I will be mega retired by then.
Man, you're gonna have a party on your yacht.
Man,
He's gonna be living off his dividends.
I'll also
the dividends alone, man. Like
no, so
cash flow.
The true cash flow. I'll add as a disclosure too, because why not? That I also did. You guys see that today? I actually sold puts on Meta. Addition to buying comments, I've also
I don't get why you did, but that's why not just buy comments.
What, 400?
No, I did buy comments.
Oh, you bought, okay.
So I bought comments not today, but recently I bought comments.
It rhymes
right
with
after earnings last week.
You remember how you mentioned the box, Andrew?
Mm-hmm.
No, that's not that.
Related around there. No,
it's not. No, the math's not related to that.
Oh,
never
mind. Never mind.
But it's basically forward buying or expressing an interest in forward prices that if I were to see them by that time, I'll definitely be deploying that capital into it. But it's not a significant amount. It's kind of just generating an extra interest on cash that I have sitting around in my savings. that I would definitely start to draw from that anyways.
Hmm.
Like that account could go down to 0. All right.
What do you think, really
Why
quick,
not?
before we?
Mhm.
I know we're on meta still. What do you think about this? I'm going to call it ARPU because it's easier to say.
ARP.
Increasing even as they expand to half the world.
A miracle.
Yeah, it's pretty impressive. Because
Yeah.
once you go ex-US, usually
it's
your
hard.
ARPU falls off a cliff, as we know with Pinterest.
Hmm.
As we were talking about that, but that's interesting.
Yep.
So Meta, yeah, wonderful business that everyone hates on, and
That's
it
what you
has
did there,
the
Andrew.
insane investor base that I don't know caused the extreme volatility we see in the stock all the time.
Do you actually realize how crazy this ARPU is right now?
Yeah. Oh no, trust me, I'm looking at this too, and I'm like, yeah,
I didn't
Snapchat.
look at this. If you
Copes
don't
and-
understand advertising, this is actually incredible ARPU.
Oh, Andrew, why don't you own this? Like, what is?
I don't have,
No,
dude. Do we need
yes,
to go
yes.
through where all my money has gone for the past year?
He also has passive holdings, so he does technically own it passively.
No.
Nah.
Oh, that doesn't count. That doesn't count. Okay.
That doesn't
That doesn't
Okay.
count.
Oh,
does
I
not-
also own Nvidia passively, so
Yeah,
I
yeah.
mean,
Tesla. All of us who are passive, or at least somewhat passive.
oh,
Well, my health savings account.
Yeah, and your HSA.
I am enjoying this rip your face off rally from Tesla.
It
I
really
just-
moves the needle.
Let me just do
It's
really
fun.
quick. If we do,
We have the
some
last
math
segment
here
to
real
talk
quick,
about, but the last segment's open on purpose, by the way. This is where
I know where you're gonna go.
floodgates open. Oh, come on, Bacon. You don't know where I'm going.
I know where one.
I am not a non-playable character. I have free will.
So-
I'll have you know, and I'm offended.
The AI told him that.
If
Yeah.
you see a more traditional ad market, you should see somewhere between. I want to say somewhere around $15 ARP Q4 of this year. You could do the math on converting that.
Wait. What'd you say? If in a more traditional ad market,
You should see for Q4 this year about $15 per person. Okay. These guys are so diverse. I'm used to more like, well, no, because Google's the same way. I need to go back and pull I have a chart on this. I have like 15 different companies going back a few years on there. But I want to say on average, it's a 30% increase over Q1 to Q4.
yeah.
That's pretty impressive. If that happens, their guide was for an uptick in Q2. By how much?
By the way,
over Q1?
can we also address the fact that their number one threat is basically just like an utter chaos right now?
Oh, they might actually have more this year because of the election. I don't know. I'd have to do the math on election years. I don't know if it impact. I don't think it's material enough to impact.
It's not. No, there's other ones that's more material for them. Like we talked about, what's it? Nexstar Media Group.
Yeah.
For them, it's much
Oh.
more material. But
Just saying the name.
yeah, just throw that in there.
Okay.
He's not happy.
We don't need to say this for too long. But no, that's an interesting. That's a very, very good.
By the way, super anecdotal because I sampled the population
Okay,
and
Jeremy.
interviewed them about this, and the general consensus is like, TikTok is kind of cringe now. But depending, I guess, on where you're at in the country, because I also spoke to Ryan Dingler, and he says he likes TikTok more, and he is in high school.
Was TikTok ever not cringe?
Well, no, to me it was always cringe. To you it was always cringe. To Jesse it was always cringe. To Bacon, he's on there all the time. But
Thanks, Bob. Yeah.
No, I've seen all his TikTok dances. You guys haven't?
yeah, I've seen them too. It's very, very wonderful. But yes, it seems like it's expanding more in the younger crowd, though. There's more of a debate among whether it's completely cringe and Reels is more appealing and okay to use, which is, I mean, guys, let's just remember that Mark Zuckerberg bought Instagram.
Stole it, really. Like in
bought-
He
hindsight.
bought it for
the
$1
price
billion.
tag.
Do you
Yeah.
remember the? No.
It was a
It
meaningful
It was
number.
that
not.
was
back
like-
then.
It was not
But-
perceived as a steal. Let me tell
Yeah.
you.
No, it certainly
People were
wasn't. But
furious over this.
yes, hindsight
People
though.
were. In hindsight, yeah.
Yes.
That
yeah,
guy,
stole
that
it.
guy is like somewhat like a Warren Buffett there. Okay, in the sense, like, what is
Absolute mad
what is
lad.
the return on investment that Meta has received from Instagram? It's probably monstrous.
Insane.
Dwarfs it, yeah, like
Monstrous. So, actually, I don't want to go that crazy because I don't know if Instagram is worth $1 trillion. If it's worth $1 trillion, it's like it's up there with like
No.
the compound annualized return. But if it's worth like several hundreds of billions, you know, that's like 100 billion would be 100 times the return on investment.
Okay.
I guess if you annualize that percentage from when Instagram acquired, yeah, that's actually stupid.
So, as a lot of you people know, I don't have social media.
No one knew this
What?
except for us.
That's what I meant by you people. What do you mean,
You
you people? But so what? Like, what's more popular now? Is it Facebook or Instagram?
depends on the age demo, and the numbers do fluctuate as time goes by.
Yep.
But I'm inclined to lean towards Insta, probably. I'm
Is that
I'm out
really-
of date.
Oh, come on, guys.
But
Obviously, Instagram.
No, because like, okay,
Oh, depending on where you are in the world, though. And
I was
yes,
gonna say where I am, I feel like Facebook is much more popular than Instagram.
that's wild. That's wild to me.
again, it does depend on certain demo categories, like how you categorize. Like,
By the way, where I live, not that you guys know where I live, like people don't have websites. Like I'll go to some place and I'm like, oh, they're closed. And then someone will be like, well, yeah, you have to check on their Facebook page. Like they said on their Facebook page they're closed today. And I'm like, fuck, I don't have Facebook.
Yeah.
You understand? Okay, so I for reasons have started to use WhatsApp a lot more. And I sort of get the appeal. And you know what's funny is it actually removes the walled garden of Apple already among key demos, and that's growing in the United States. By the way, the Latinos all use WhatsApp, like every single one, and the Brazilians too. Well, Latinos, Brazilians, it's all the same. It's
you
just like all jumped up. Yeah, I'll jumble the whole demo in there, and they all use WhatsApp. And it's funny because you'll be texting someone who has an Android and has an iPhone. Well, if you do iMessage, if you know, I would say like the more American-born natives, like Caucasian, African American, when they use an iPhone, they'll use iMessage. But Latinos, bro, it's like WhatsApp galore. And now, who knows if you have an Android or an iPhone? So it's
But Facebook is basically just the new Craigslist.
oh yeah, they just killed Craigslist like overnight.
Yeah, they like killed it overnight. And like anytime you go to like get rid of something or anything
Wait,
like
so I can
that,
go for
like
my prostitution
Facebook
now on
Marketplace.
Whoa. Did Jesse not hear that?
I did not.
He said an illegal product.
Oh.
That's more of an action of one individual selling their primal instinct to reproduce to another
Oh. Okay.
Dude.
for monetary reward.
Dude, I just pulled up Craigslist. This thing is straight out of the 90s still.
Bro,
Oh, dude,
for real.
discussion
For real.
discussion forums now? Gaming? There's discussion forums on Craigslist?
It's the new Reddit.
Oh my gosh. This is still it's completely set up just like a 90s like oh my gosh.
you've never. Is this your first time on Craigslist? Question mark.
Also,
Dude, in like the
Facebook-
21st century, yeah.
Ooh. Okay, what about this, guys? I would think ads would be much more valuable in marketplace.
Yes,
Yeah.
Much
because,
more valuable.
because you have yes.
Mm-hmm.
I have a willing buyer.
Buyer, yeah. You have someone
Willing
that is
buyer,
deliberately looking.
and you have tons of data on them, and you know what
Yes.
they're looking for.
Yes.
You're basically Amazon at that point.
Well, because like it's actually
Fabio. I see you, Fabio.
it's why I think Fabio is so much heavier into
I feel like you're
advertising
cringing.
than I am.
Like,
What'd you say, Andrew?
I said I find it so funny how much heavier you are into advertising technology than I am.
Yeah, because I'm closeted advertise investor. Like
Yeah.
I'm closeted. Like I don't
Dip
admit
it
that
in.
I am. I hide under the veil of like big tech, moats, blah blah blah. And you're like, it's an advertising company. And then it's the meme of like I'm the guy, Wojak crying behind the mask. It's like, no, it's not. It's not an advertising company. It's a technology company.
But you know what was an advertising company? It was Perion. Now they're just a cash proxy.
What a
how are they doing? How are they
Oh,
doing?
they recovered a little bit to like $12.
So
We'll
they're
my
still
puts would have
pretty much-
still
No, they're
been.
$12.47.
Oh, they're
pretty much
just
where I sold.
all right. All right. I kind of want them
Where I
to
covered.
Are you laughing here?
Always.
Okay, well, I mean, I'm thankful I was along with the ride on this.
So I feel like now let me correct the timestamps because I'm trying to keep these timestamps. We're at what? We're at 2 hours and 28.
Yeah.
So I'll do 2 hours and 30 as the discussion for the troubled and boring
Troubled.
industries.
Yep.
So the first things first, poor Fuhat. We'll get through this. I frankly, does anyone know what this is?
No,
I
think
tried to
IPO'd
look
like
at it.
yesterday.
Okay,
Yeah,
okay.
yeah.
Let's play a game. Can we play a game? Wait. Can we play a game before this? Because I
Okay,
haven't
okay,
looked at this.
All right, shit.
Over
Okay,
under 100 million market cap.
over.
Oh, it's over.
I'm thinking
It's
the
over.
under.
It's over.
He's already spoiled it. No, he said it's over.
Yeah. No, but like,
I'm gonna go with
Oh,
what you said, 100 million over under.
yeah.
oh, this
I'm
could be
gonna
just
go with
IPO.
420 market cap.
No,
Okay,
it's over that.
Okay.
Oh, wait, you never said million or billion.
Over under $1 billion.
It's over.
Bacon, stop. Stop.
Oh, I mean, I'm just saying what my guess would be.
Oh, he's saying with
Yeah.
such confidence. I thought you looked it up already.
No. Here's the over/under one because it's Fuhat. Is it private equity, a bank,
I like this.
or
Yeah.
a
No, wait. Can I just say
financial service?
Bacon, I thought you had it up, and I thought you were spoiling the over under because you were so confident. Probably good at poker. Just say.
Oh, me?
don't know.
I can't do math. My math.
All right.
Actually, interesting.
Rubric.
Yeah.
Tech company.
Yeah.
Software.
Yep.
I'm gonna guess software. Rubric, because it sounds like it's a rubric for what though? I don't know what they service. I want to say because it's Fuhat, it's gonna be like restaurants, food related.
No.
No, this is actually an interesting industry. Is Jesse still here?
Yeah. Just
Yeah, no, I'm looking at it right now.
Yeah, because I was gonna say like
Have
I
you ever
think,
worked with them?
Overview of it that I'm pulling up.
like Fuhat actually probably was still relevant because this got mentioned around the cloud topic, so something cloud related.
It's a $6 billion co.
Hey,
They IPO'd literally like on Friday.
less than a week
I knew
ago.
it.
Week ago.
Based in Palo Alto, the stock. No, I'm kidding.
No.
No.
Gets acquired by Palo Alto.
The place, not the company, but it's based in Palo Alto.
I gotta find their S1. Is this it?
What is this company? Okay, so
I gotta run, guys.
all right.
No, very
Wait,
sad.
before you
Sorry.
do, have you
It
ever
looks
heard of or worked with them?
interesting, Fuhat, but I would have to spend a lot more time on it than 5 minutes or something.
Yeah, because the partnership that they have with CrowdStrike makes me wonder what exactly is the value add. But
Okay, so here we go, guys. I'm going to share my screen.
Bye-bye.
bye, Jesse.
Bye.
Thank you for joining.
So they appear to be, this is their S1. I'm pulling up
Yes.
here. They're a cybersec company, just IPO'd. So one of the things you always want to look at is, can we look at where, well, we can look at the actual company itself really quickly. Where are the proceeds going? Oh, this is so, okay. Dude, what is this? Why do you have to make this like this blue that makes it hard to, I don't like this. Class A common stock, Class B common stock, rights of holder, Class A common stock, Class B stock are identical except with respect to voting. Oh, okay. So you don't get any voting rights.
Different. Yeah.
Each share of Class A common stock is entitled to 1 vote. Each share of Class B is 20 votes. Okay.
Cool. That's set up.
So one of the things I want to look for is this being is a PE company spinning these guys off? One thing I do is try to look at debt, but then I'm trying to see is where the proceeds of this IPO are going.
And I can tell you, yes, venture capital, PE venture capital spinoff. Yep, I can already confirm that. Too.
Okay. All right. So it's not
I'm
a
going
PE,
to tell
PE, but it is a spinco.
what I will tell people is PE companies are not dumb. PE companies are opportunistic. You can win from buying potentially a PE co at IPO. 99% of the time, you're going to lose.
You are the
So-
exit liquidity.
You literally are. So we intend to use net proceeds to go use cash.
And it's funny.
Yeah,
I
so
think
like-
they have that.
Satisfied all our anticipated taxable and remittance obligations with our RSUs. So they're paying RSUs to the private PE firm.
Winner.
And honestly, Fuhat, they have their balance sheet isn't as clean as I would usually expect from early stage tech cos. Usually when I see early stage tech cos, I see lots of cash, no debt. For maybe even free cash flow negative earnings. They're not making any money, but they have a cash hoard. And then so you don't value the cash hoard as a cash hoard, you value that as their runway.
Right.
That they have to get to cash flow profitability. This is already starting off with a net negative cash position.
Ooh, very sexy.
Yeah, so stay away, 100%.
Are they cash flow positive or negative, you say?
That looks like, well,
Pro forma though.
yeah, exactly. Pro forma is like
Let me see.
negative. I'm getting negative 4.5 operating and negative 12 and well, they're already negative in operating, so I don't have to continue.
Secretly, I hope.
Let's go to the MD&A right here. Is that going to be where I can find these?
And then you could also just Command F or Control F for cash flow operating activities. See if they give you that. Two negatives make a positive. I'm all in. That is the right mindset. That, detective,
Is the
right question.
Wait, so how comfortable are you guys with pro forma accounting? Because pro forma makes me
Skittish?
want to cry.
Want to cry?
Yeah,
Okay.
like whenever I've like looked at things on an
Pro forma just essentially means I don't know. I don't have one. I don't feel one way or another about it. Primarily. This is
question mark.
Okay, so wait.
not
There's
great
some
growth.
There's
You're going from 599 to 627.
Winner. Tough comps.
Wait, why do I have notes but no financial statements? Wait, what?
Yeah, the magic and beauty of pro forma.
I'm seeing. Hold on. Wait. This valuation is applied to this return.
I don't think we need to spend too much longer on this because my thing would just be here we go. Here's statement of cash flow.
Yay.
Ooh, net loss. So fun. Let's see.
Winner.
They're pretty close to cash flow positive, but I mean,
It looks like
here's-
they were last. No, sorry, not last
Yeah.
year.
no, they were from operating. But financing is a real thing you have to look at for them.
What's their cash? Go to the balance sheet. I want to see if this data
That's what I'm
aggregator
looking
is right.
This growth is putrid too.
Reminds me of
cash equivalents.
AYX. No. No.
No.
Isn't AYX getting acquired? Yeah, they got acquired.
So very close to break even on debt, it looks like. But oh, don't you love this? Okay. So can we talk really quick about classic PE playbook here?
Fire away.
What do you do if you own a company and then you want them to look like they have a lot more growth and a lot higher projected EBITDA right as you IPO them?
Borrow tons of money, buy a lot of other co's.
Yep.
Exactly. You go here and look at this debt non-current from 179 to 287.
Hey, what's a casual massive
Look.
jump in goodwill between friends?
But look at this. The cash balance went down.
Yep.
So let's see. Investing purchases.
No, you
Other
could have
than
just seen it with
equipment.
goodwill.
Purchases of investments.
Yeah.
Sales. Oh yeah, right. Let's go look at goodwill.
Yeah, it just
It's
skyrockets.
Yeah. It's
Oh,
just
does it?
Yeah.
Yeah.
look at that.
Oh,
Skyrocketing,
it's almost
that's
like I work for a
really
PE
what
company. Or PE owned company, I should say.
Let's get this bread.
But man. So what basically is happening is they're saying we're gonna take some lipstick, we're gonna put it on a pig, and then we're gonna sell you the pig. And we hope that you will buy the pig. And and like the company could be good, although what's really scary then is they did all these investments, but their revenue hardly grew. Like you spent more money buying company, like your goodwill went up by more than your revenue. Like, isn't that scary?
No, nothing scary about this.
Just
Reminds
imagine-
me of
is it-
Alteryx. This is not at all Alteryx, Fuhat. Alteryx was growing at one point at like 130% a year. And yeah, it slowed down towards the end, but Alteryx had an issue getting licenses over to students. So a lot of employers were much more, let's call it, likely to use offerings like Tableau. Because Salesforce, holding of mine, is really good at that.
Although I will say the
Subscriptions.
potential positive thing, yeah, subscriptions have gone up a lot. So their AR is going to plot. I'm kind of shocked they just have like other. This is kind of weird to me. Why is your second largest segment? Like this is way too big to just be other.
Yeah.
On either of these, I feel like.
No, Dan, the pig is not delicious. It's quite disgusting.
Yeah.
Oh, sorry. You're referring to the other side of the trade. I'd be scared to do that too, but more likely than not, there's a lot of problems here. Yeah, Dan wants to make money here, but not the way Fuhat wants to make money.
Oh, I don't know. It's too hard for me to say. So
just imagine if your investment portfolio was like goodwill from last year and then ballooned to where it is this
let's
year.
see. What's their investment? They're not going to get any money from this, right? So the money's going to the PE firm. So what's their runway? That'd be your question. And will they have to dilute more? In fact,
Pencil it in.
no, they even have a section called dilution. What you'd want to do to figure out this question, okay, first of all, see like dilution, capitalization. So if we go to capitalization, like, I don't know if we want to start going. This is boring stuff that I would do to actually see like what this company looks like. I'm yeah, we want to see
Something
like
for
solution.
something for our channel. Shout out our channel.
I love this first sentence. If you invest in our classic common secondary offering, your ownership interest will immediately be diluted. That's what I like to hear. To the extent of the difference between the IPO price per share and the pro forma as adjusted net tangible book value per share. Okay.
Blank million.
Dilution information. Bro, wow, look at this. Incredible. Generators exercise their option to purchase shares. Yeah, so this is just saying everything they owe to the people. You'd want to go through and see this. Let's just look at runway, though. We'll go back to that. We'll go back to runway.
Yeah. We would also probably care about any sort of Class B to Class A ratio, as far as like if they wanted to convert.
I mean, if that's net retention rate, that's pretty good. Like, it's not all bad. I just don't know enough about this company. I wouldn't be buying it.
No.
Okay, so let's go back. Come on, just give me your freaking balance sheet. I should have kept track of what page I was on.
The balance sheet. Goodwill.
Oh, that's good. Just Goodwill. Because they probably want to talk about Goodwill very much.
Fingers crossed. Not too many entries.
I mean, it's just gonna be up from here, but because we'd also want to look at the interest rate and duration probably on their debt to see when they need to start refinancing.
Yep.
And when they would need to dilute you.
Mm-hmm.
Here's their revenue. Let's see.
Quarterly.
Oh, it found Goodwill. That's why. There we go.
There we go.
This is a statement of operations. Oh, what's their gross profit? The gross profit margin is not bad.
I would hope so.
Expect that
Even
from this company.
yeah.
So, all right,
No,
but
you would. I'm just really quick. I just want to say this other is so weird. They have this like really high margin subscription company that has like this other, but then there's like a massive. I don't. Anyways, this is going too long.
interested or not interested?
In buying, no. In investing more into this, in looking more into this, I actually am. Just like from
I'd
seeing
look
what's
into
going on.
it to maybe think about shorting it, if anything. Good
Whoa.
short. Foo hat. Okay, so there's for troubled and boring industries. I want to know what Bacon was going to predict as far as what stock it was.
Oh, no. I'm not going to go with stocks. I'm just going to go with industries.
All right, what industry?
Sir.
Because if it's not that one, then we're going to talk about it anyways.
All right, so broad
that mean?
umbrella,
Broad
retail, specific and under umbrella, grocery or grocer. Then you also, I wouldn't be surprised if you talk about airlines, because those are boring and perceived as troubled. Let's see here. What else?
Yeah, good guesses.
Maybe I could see you splashing in a consumer staple, but not as likely. But you're aware. You're
Andrew
aware,
would
and
love
I'm
a consumer staple
pretty
in
sure,
there.
pretty
I
sure
know.
Andrew would as well. Yeah.
They report this week.
Yep.
Aren't you excited?
Oh.
All right.
So yeah. I'll just leave it at that.
All right, we'll go down that list. I think that actually covers at least very troubled industries. So troubled and some of them boring, and then some of them both. So I think let's start with the one that everyone hates. I like the reaction from people usually. So let's go. What's the this one?
JETS stretch.
Yeah, everything money's favorite ETF for whatever freaking reason. No idea why. All right, so jets. We have airlines.
Yes.
Okay, so there's a lot to really discuss here. Everyone hates them. Everyone thinks they're disgusting businesses, and I tend to agree. So, what is going on with some of the particular names? We have Delta Airlines that I'll just cut through the chase here. I saw that their margins started to ramp up closer to about the 8% range, net margins in particular. And then I have a question for Andrew, because I'm cheating because I already asked you this last time. So, what is this? EM's like at LEV? Well, Dom stocks. I don't know if you've watched EM long enough to see that they really push the Jets ETF. I don't know why. I don't know why. But okay, so are travel volumes going to be increasing or decreasing in the future? Yes or no? I think that question is easy to answer. The next ones are harder.
I'd say increasing.
Okay, good. Bacon,
Yes.
increase or decrease?
Maybe. I'm leaning towards yes, though. That's what I
Okay,
think.
I also lean towards yes. So increasing. With that being said, now we have a bigger issue arising with margins. So what we saw prior to COVID is margins were pretty good. And then in 2017, margins were fantastic. But you have to blame that on where energy prices were. If you guys recall, just after the election, we saw probably one of the lowest or cheapest energy prices ever. And that really helped out with margins for airlines in particular. And so you can't really use those. Okay, you use maybe 2019, 2018. You have COVID and you have all-time low in margins. And then you still have relatively weak margins for some. Delta Airlines recently broke out. And also that's probably why you see this performance recently with Delta. That's probably why you're seeing that strong performance relative to peers. Delta's debt also relative to peers is not that bad. American Airlines is probably the worst. And then Southwest Airlines is probably the best. Southwest right now, I won't be surprised if they actually experience a similar rally to Delta if they are able to get margins back in line with historical averages. Their historical average, I guess, not after COVID, pre-COVID, but not too far back where you're getting that muddy data, is anywhere from 6 to 7%. So if they get there, that's what, a triple in net income, and they're trading at a 20 PE, somewhere around there. So they had a whole troubled situation I know Andrew was a part of, where their whole system went down and they had to bear the cost of that.
Oof.
That was yeah.
I remember that.
So the energy is going up, and I really don't see how they don't pass on cost to consumer in the ticket prices. There's also one upstart that is going to die, and that is good for the rest of them, and that's Spirit Airlines. So Spirit, this is the biggest problem, and why I think that, for full disclosure, Airbus is a very interesting investment proposition. Not Boeing, not yet. Boeing will be one, but I'm keeping an eye on that one. But Airbus is a really good investment proposition, because if you look at Airbus's pipeline, they can't get you a plane until 2031. You want an airline now? You want an airplane now? Yeah, great. 2031. That's the wait time. Sorry, buddy.
They should start offering fast passes.
Start offering fast, but yeah, no. So it's a problem for them to grow. And so that's why JetBlue wanted to buy Spirit. Spirit's not going to survive. And that silly judge who thought he was saving Spirit is just causing the inevitable, their death, their doom, and their assets will be sold. So now the investment thesis behind Spirit Airlines is not, will the company thrive, is how much can I rip apart its body and sell it for? And is that more than what's being listed right here? So Spirit, get used to it, use it, abuse it, and soon it will be a corpse, and you'll be able to tell everyone you flew Spirit. So yeah, and then you have what? Who's the other one that's the cheap one? It's cheap is a relative term, because it's honestly like when you end up paying for bag and all that. It's
Ryanair for the EU.
No.
people.
In the US. Spirit and come on, Spirit and
Virgin?
Frontier.
Oh, Frontier.
Frontier. So yeah, you get Frontier. Maybe some of these are gonna be dying in the near future, and I wouldn't be surprised. Really, the big four, the big players, and perhaps that's the consolidation the industry needs. I think that eventually, I wouldn't be completely blindsided or surprised that if there is some sort of dynamic change and the biggest players are able to capitalize on that and still generate some profit.
I love the reason this is so funny was because of why the judge said like it's important to keep Spirit Airlines alive because there are customers that love Spirit. Like, and the funny thing is, in reality, everyone's just like, dude, Spirit sucks. Good riddance.
Yeah. It fits perfectly well within the narrative. So Spirit, that's why they wanted to get bought out. It's the planes, access to the planes. And that's really how you grow now. So that's the huge barrier to entry across the globe. It's getting access to new planes. I think you have Qatar making a bid for another airline, a European airline, and we'll see how that goes. But really, again, that's how you grow now. And so the biggest players, the big four, we'll call them, they're doing okay in terms of at least profitability. They're going to survive. And Southwest Airlines is the best capitalized among the big four. Now, for the time being, again, it is a competitive industry, but I think that maybe there's a potential that at one point, you get some sort of change in the industry just by the very nature of everyone else just kind of collapsing, dying, and the barrier to entry by buying a new plane is becoming higher and higher and higher, it seems. So that's good for two businesses, Boeing and Airbus. And Boeing is so lucky that that's the current dynamic, because if that wasn't the case and Airbus was able to fulfill everyone's orders, then Boeing would be a dead company. We would actually be looking at some sort of bailout potentially. But thankfully for Boeing, that Airbus can't accommodate everyone's orders, and so they'll survive. Then you also have the adjacent businesses, right? You have General Electric, aerospace, fantastic business, service revenue ramping up nicely, but you're going to be paying an arm and a leg for that because they don't have any of the issues that, for example, Boeing has, but you get the same basic exposure, economically speaking, to that industry, the good side, not the bad side, and the bad side being the airlines themselves. Most people don't know this. Coming back to airlines real quick, is where they actually make all of their profit from is the point system, not the flights. The flights themselves are the reason for you to get involved in the point system. And if you didn't know that, well, welcome to Capital Mindset. So, but anyways, boring and troubled industry that I actually do think, I'm not going to buy it, but I wouldn't be surprised if there's some upside in some of these names. I mean, you're starting to see it, so it's not like I'm finding this before it's happening, but what I'm trying to help explain why you might see it is just margins start to normalize, and that would imply that earnings growth is going to be quite strong in some of these players. LUV has been the one that's lagging. So funny enough, if you had picked Delta or I think United Airlines, UAL, not AAL, that one I don't know how that one's performed. So I think UAL has also done okay recently. Paul managed to pick the worst one from a performance point of view over a short period, or one of the worst ones of the big four. Let me quickly correct myself because maybe American Airlines has done. Oh, sorry, let me put that. Has also done bad. No. So it looks like he did actually end up picking the worst one over the time period from last October. So
he does not miss.
He does not miss. Hence why I got scared out of a couple stocks that he bought, because I was like, this guy doesn't miss. He's actually that guy. He is that guy. The other industry that I'm actually more excited for, bacon. You said it.
Groceries
stocks. So grocery stocks. I added a position, and I don't know Andrew's opinion, so I'm going to ask him publicly. What is his opinion on my grocery investment? I don't know if he's excited about it or he's like, what the hell are you doing?
You're talking about Inglés?
Mm-hmm.
Yep. I do have another guess, by the way.
No, I mean, I think it's fine. I think it's just like kind of like a value play more than anything.
Yeah.
I was going to say, someone linked me, by the way,
Mhm.
a breakdown of Rubric
Yeah.
from. I'll make sure I'm not giving away anything that's not. I think this is public. Let me just double check. I don't see why it wouldn't be. But it looks like there's a lot more to this company, so maybe it could be interesting. But like, I still think, as a general rule, don't invest in companies in this situation where they're getting levered up and proceeds are going to someone else. Anyways,
Oh, yeah.
sorry to.
Hmm.
Yeah.
And Ingalls, your thoughts?
Besides value play. Yeah, I mean, what you're getting here is, I think, yeah, a cheap stock, every which way you look at it, PE ratio, blah blah blah. But the real part where there's a lot of value is, of course, the real estate component, and some of the unit economics that people sometimes don't get about groceries is that the real estate is not your enemy; it's actually your friend, even when you're leasing it out. So when a grocery company doesn't own a lot of the risk, I don't look at that as necessarily a ding. A lot of the capital leases that they're going to get really good rates on that, really good controlled, nice rental growth rates. Why is that? Because you're the anchor tenant. The anchor tenant always gets the advantage in the lease negotiations, just by the very nature of what they are, anchor tenants. So the grocery in any strip mall that you might go to, you'll see them, and then you'll see a bunch of businesses around them. Those are the ones where the landlord's going to make all the money. So if you ever structured a commercial real estate deal, you probably would do exactly that. You want the anchor tenant to be there, and you want to incentivize them to stay for a very long time. And so they're going to have a lot more negotiating power with you. And then the other guys, the ones in the smaller units, you're probably going to increase their rent a lot more than you would, the grocery store tenant. Now, in the case of Ingalls, they own the vast majority of the land, and they own a lot of projects that they're still probably going to develop in the next couple of years or so. Then that's how they expand to new stores. The stores that they do not own currently, they used to own, and they did a sale leaseback back in the 1980s. Fun fact. So really long-term leases that they establish on that land. And of course, at any point in time, the company could decide to start looking at that as a way to raise capital and do whatever they want with it, really. The cap rates that you'll receive on groceries are actually fairly attractive for commercial real estate property. Again, when you lease it back, you're going to get very controlled rental rate increases. So there's a huge benefit there too. And your costs are really contained. It's not a thing that can really get too stretched out. The other tenants, though, it's a different story. So Ingalls, for the most part, in a lot of their properties, they do rent out the other units. So we get that. But the other part that I think should be stressed with Ingalls, that hey, it's cheap, is the buyback component that I saw people talked about in the chat. The buybacks that Ingalls undergoes is typically, but not all the time, done at or below book value. So, let me say this.
And where's Ingalls right now?
It is below book value. It's at 0.8 book value.
There are annoying cons to this company, though. Like, fairness to the viewer.
Tell me the annoying cons.
This is not the most shareholder-friendly investor relations type of group. Like, if you took a look at their website, according to Fabio, at least, getting any sort of details, they are fairly responsive. It's just that, if you expected nice, clean, interfaces on things, nice, clean, and dolled up stuff, that is not it. If you're expecting for lots of analyst coverage, also not it. But yeah, that's like the thing that stands out like a sore thumb: the lack or minimal of amount of public facing investor coverage or analyst coverage. Derp.
No, but I genuinely view that as a positive in the sense that I probably get a bit better entry point just because people, no one's paying attention to it. So
Scratch.
Yeah, I was gonna say, sorry, 3 hours is kind of getting to my my max.
no worries.
Uh,
This is a good ending point.
Oh wait, I'm still here. We'll keep it going. We'll do it live.
All right, we'll keep going for just a tad bit because there's probably one more industry that we can talk about.
okay,
Yep.
so I hit this end stream button right now.
I remember.
All right.
Bye, Andrew. There we go.
Okay. Oh, this is great to address. All right. So, Prattman, help us out here. I joined a little late and was catching up. I heard someone mentioning earlier, AWS just announced a partnership. I might need to catch up to Microsoft. That's not completely true. Note the announcing AI partnership has recently become trendy. So, okay, so that's hopefully the case, right? Because that it's just an announcement. Plenty of times companies announce partnerships and it's mainly publicity more than anything meaningful. So hopefully that is the case. And so I don't know if you're more familiar with the matter and you want to expand upon that, and then we can discuss that further. I'm more than willing to go back to it. Has already had has always had partnerships. Okay, fair enough. Yeah, because that was just kind of addressing a potential cautionary note. I'm trying to find where it could go wrong tomorrow. Full disclosure, I have a large position in Amazon. So, all right, but back to boring, misunderstood businesses. Yeah, I think grocery store chains, a lot of people think inflation's a big problem. No, inflation at relatively observable rates from the past, it's not a problem for them. They're just middlemen that pass on costs to consumers. Of course, the rate of change, if it's extreme, like something like hyperinflation, well, no one's immune from that. So there's one more boring business or a sector I wanted to hear. My man. Potatoes. Yes, Lamb Wesson.
And you say I forget everything.
No, you don't. Lamb Wesson. So this is another business that I bought, and it's like quietly going up and up and up and up and up and up. So this is one of the newer investments in the portfolio, both the holding co and the personal holdings. So the one thing I will say is that it's a very interesting and unique situation. There's also that one unique situation that we'll discuss.
Oh,
the other stock. I'll talk about that publicly. It's a small investment for me, and so it's like, and it's not. We can't move it, but it definitely can't move it. So Lamb Wesson, what do we got going on here? A massive failure of implementation in what was it, Bacon?
Rhymes with ERP.
Literally is ERP. So yes, ERP. What does that mean?
All right,
well,
so
it means.
go ahead.
There you go.
Oh, I just was gonna say the software that they had for everything when it comes to inventory and order management. Like if that completely collapses or messes up in a dramatic and drastic way,
yes.
Yes. So like the best reference that I remember is in the past Nike had an ERP screw up.
2004.
Yeah, and anecdotally, like this has scarred management teams so much so that I looked at a furniture company not that long ago, a company called Our House, not an endorsement to do anything with it, but that was a Q&A point. Was hey, we're gonna do an ERP system thing, we're gonna roll it out slowly in phases, blah blah blah. Like so, yeah, any sort of mess up with an ERP can produce violent moves like we are seeing right now with Lamb Weston.
Yes, and Lamb Wesson traditionally has always traded at an expensive multiple. This is the one time I've ever seen it just boom, destroyed overnight. And if you trust management, that's the key, because that's the risk here. The risk here is, we don't know if it actually is a 1 quarter problem. It could be a multi-quarter problem, a year problem, 2 years problem. We don't know. But the management says it's a 1 quarter problem. It's already fixed. It's behind them. Okay, if that's true, we'll see that in the next earnings report. That will determine whether or not it's good to add more, or kind of chill out a little bit and wait a couple more quarters. If it's the second one, then you're probably going to experience some pain if you're buying now, and you might get a lower price. Might be that point to consider an entry. But the point when management kind of guides for improvement in the next quarter, which was this quarter, you want to start to see, okay, was that true? So it's buying now, you're taking on a risk that guide's true. Overall, business is pretty good. I mean, it's a simple business, really. They pretty much are in a triopoly, I believe. And I don't think it's a duopoly. I think it's a triopoly. And the largest players in the game, think of McDonald's, they use all three of them to fill that order. So it's almost like guaranteed business. You get lower rates there, but the profitability metrics are fairly good. The barrier to entry is a lot of capex and building out these sites. So you don't really have anyone that really is going to step into this. It's resource intensive with potatoes. Potatoes is a good crop. Recoverability rates are pretty good. I'll talk about recoverability rates because there is another boring stock that I'll talk about after this, before we get to the special situation. So low growth. Dom, I don't know where you see the low growth from, or what you define as low growth, because in the past they've grown quite a bit, and even sell side estimates on average are decent for what you're getting with Lamb Weston. Really, the multiple right now I see, it's deserved in the sense that there was a hefty blunder in the management team's implementation of an ERP system. Maybe that speaks more badly to SAP than anything else. So yeah, the bet here is it is a 1 quarter situation, and yeah, you get, if you're a dividend growth investor, you might like this one. Boring, not really looked at. So the other boring business, similar and adjacent, I want to see if you guess this one, and kind of we'll combine them together because I kind of hinted at one of the problems. It's supply chain repairability.
Oh, that I'm sorry. I have done the best I can. I have failed.
Tyson Foods.
Oh yeah.
I don't own Tyson Foods, but it was received as a heavy endorsement. I pitched it in the club, and really talking about Tyson Foods here. What you're going to see, and it's going to rally before the actual improvements are seen. So I'm talking about it now because I think like it's been a while since the initial pitch in the club. So what you're getting with Tyson Foods, largest chicken maker, beef maker, and all that pork, you have 3 different parts about the business that you want to focus on, and that's the 3 different meat commodities: chicken, beef, and pork. Pork recovers every 6 months, or takes about 6 months to recover. Chicken recovers 3 months, and then beef takes about 2 years. So beef is the main problem that's occurred recently. Actually, there's a new development, and so Fuhat in the chat's probably screaming because
he is.
He has the unrestrained obsessions. But the thing with Fuhat, and when he talked about it, was actually pretty high. So I'm gonna diss you, Fuhat, a little bit. But the new development, and I don't know if Fuhat was paying attention to the new development about the avian flu spreading to a lot of their bovine stock. That could end up being a problem that further delays the recoverability. And so actually I view the Tyson Foods trade, and recently discussing with some club members, it makes sense to kind of approach it this way. You could elect to do the common stock approach, just buy the commons and set it, forget it, and watch it correct and play out. And really, again, you're going to see a huge recoverability in the shares before you see the results in the numbers. Very classic of cyclical businesses. It's all going to be about the guide. They're going to guide to you about probably 1 or 2 quarters before the recovery that things are looking up for the beef section. And everything's going to, all your ducks in a row. If you get, you could have another tailwind from China, increased pork demand could be something that you could, not really foresee, but like a gray rhino event to your benefit, not to your detriment. And then the other part that might be more important to talk about is the play that I kind of got into other things. But I view it as sort of like a binary event where I had a timetable that part of my pitch was I saw recovery in 2025 was the year. So that kind of means if I wanted to play this, the way I think that's interesting to play it is looking at options chains and getting something that expires maybe in 2026, January 2026, and then kind of playing around with picking my strike there. And then I get exposure to the directional movement upwards of the stock. And the premiums, when I last checked, they're not that bad. You could definitely see this thing recover quite nicely as long as you see all the supply chain sort of recovered by that time. And again, it's not really, if I'm wrong on the 2025 precisely, because you would expect the recovery to happen prior to the actual recovery, which would be a couple quarters. That gives you, or that would give me up until exactly January to see at least the announcement. So probably Q4 is the deadline, and that would not require an insane amount of capital to put down to get exposure to the idea. Again, you could just buy commons and wait for it to happen, because I'm fairly confident Tyson Foods will recover. So there's that. Boring industry, high barrier to entry, all that jazz. High barrier to entry in the sense that there's not going to be tons of new chicken companies that are going to achieve the scale of Tyson.
Yeah,
There is a
economies
sense
of
of
scale.
scale. Yeah, there's an economy of scale, precisely. Now, it's a commodity, so that comes with its own risks. So you have to consider that as well. And always at the peak, you got to be careful and take a cautionary approach that when it looks cheap, it's probably expensive. When it looks expensive, it's probably cheap, vice versa. And that goes with all cyclical businesses. Okay, so the interesting business.
Yes.
What market cap is it? I need to make sure, because it might. I don't think it's in that dangerous range. Let me check. Oh no, we're not going to move it. We're definitely not going to move it. So and then I'll express how I'm exposed. So I'll talk about the business and I'll express my exposure. Okay, so TH.
Yep.
Yeah.
You had a fun game with this one.
I had a fun game with this one, yes. And so I played a game with Bacon the other day. Basically, I threw this at him and said, "Figure out what's wrong with it."
I failed.
No, I would expect most people to fail.
Yeah.
Like the vast majority of people to fail. So I won't play that game with the audience because we'll be here for too long. So Target Hospitality Corp, really interesting. I guess maybe should I first start with how I played it versus, or talk about the opportunity first, then how I played it?
I think opportunity, then how you played. That works.
All right, easy. So opportunity, business getting acquired at $10.80. I'm gonna cut it straight to the chase, by the way.
Yeah.
So we're not gonna be wasting any time here. It's gonna be like blah 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 blah, and you should understand in 5 minutes or less. Getting acquired at $10.80. A private equity firm that owns a huge portion of it wants to take it private. They offer $10.80. $10.80 would be basically a steal price for what it is that they do, and the market is voting with its dollars, and you notice this, and I was already involved before the market started moving up even more, and so it makes sense when we talk about how I got exposure to this and why I got exposure to this way. But you have not an opportunity, the market, and I agree with the market that independent directors are probably more than likely not going to approve that deal, and the deal is going to get revised upwards. Maybe something more fair, closer to the 15 and above range. And I think that's still fairly cheap from when I looked into this. So the market's moving up above the acquisition price. And that is indicative that the market, again, thinks that that change is going to happen. So the private equity firm, they typically usually don't kind of revoke the public offering, not revoke, but take it back and want to reacquire the business unless they realize that they can probably make a killing or stealing it from the public shareholder. That's a strong word, not stealing it, but taking advantage of a mispricement opportunity in the public markets. So long story short, there are a lot of catalysts that could actually play out for Target Hospitality. So for this private equity firm, there is a huge incentive for them to be timely on their acquisition. They control a huge portion of the business, but that being said, they can't just outright take it from the minority shareholders, being the public investors. So independent directors, in theory, are going to probably step in. And again, it's probably going to get revised. And again, the market thinks that. And typically when you see, an merger arbitrage or acquisition arbitrage, you observe usually a small or large discount, depending on how the market feels about it, to the acquisition price. This is not the case here. So that should have been almost like red flag number one, as far, not red flag, but like green flag number one, that there was something more to the story than what meets the eye here. Okay, so upon further investigation, you might come to realize that, yeah, that's kind of fishy, and maybe the deal might get revised. How did I play it? That's the most important part. So there's a couple ways to play it. You could have gone long comment. There's several ways, but you could have just straight gone long comments. This way had now there's downside, but at the time when I found this, it was about $10.80. So worst case scenario, nothing happens. You sell it for break even. It's a cash proxy. Now you have a loss. Now you have an implied loss from $11.31 to $10.80. That's a problem. So yeah, not the same opportunity. But the other way you can play it, you buy the commons and you sell covered call contracts on it. So now we're getting a little more complicated, but if you guys like this kind of stuff, like, share, and subscribe. So you could buy the commons and then sell covered calls against it. You'll notice that there's demand, there's liquidity, which tells you something, by the way. That's a hint. But yeah, you could buy the commons right now and you could sell covered calls. When I first looked at it, you could actually generate some fairly interesting yield with the risk. Obviously, if you are right, then your return is going to be capped at what you're selling it out for. Now, and then the gain actually is you could have generated a return because you would have bought it at $10.80, sell covered calls, and you would keep the difference if the deal went through. And then there's the other risk that deal doesn't go through at all, and that breaks up entirely, blah, blah, blah. But I think that's less likely here. And then the third way, which is the one I chose to buy calls. And that's it. That's all I'll say. I chose to buy calls. So the calls are up quite a bit, but yeah, you could have bought calls. And I thought they were fairly cheap at the time. So we'll see how it turns out. But yeah.
This was interesting. Like, I didn't get to the true answer. It's just that I got most of the way there.
Yeah.
So in hindsight, it was fun.
It's a fun case study, though, right?
Yeah, it's an amazing case study.
You don't often see these things.
Yeah.
This is like the second one I've ever seen. But yeah. And
Thanks for having me.
Yeah, no worries. There was one more thing, and we had a question on Salesforce. I think that's where I'll leave off. Any thoughts on the current Salesforce valuation? Well, actually, I think you're in the club, right? I'm pretty sure you're in the club, so you can ask me like a direct question on the weekly call, and I can go over it in more detail. Yeah, so you can ask me in the club on the next weekly call, which is tomorrow, by the way, and we can go over it in more detail, and you can basically ask as much questions. Or, you know what you can do? You can leave your question in the Q&A tab and just add it towards me, and that's how I know to do it during the weekly call or an ICOM. If you add it towards me, and then I'll get through your call, and you'll see it in the recording.
I think the person you originally highlighted, Prattman, the CRM question, they're not a club member right now.
No. I'm talking
about. It's a Griffith.
Yeah, Griffith.
Oh, okay.
I have to listen to that again.
Okay.
And so we can talk about this.
Yep. All right.
Yeah. No,
okay. So you're still talking about. All right. Cool.
Yeah, I've seen Griffith around.
Yep.
All right. So to Prattman's question, Amazon, Google, CRM are my largest holdings. All right. So Salesforce current valuation, I think it's fair. I'm not adding any more to Salesforce. It's funny because all my stocks now are dividend growth stocks. Besides Amazon until tomorrow. Maybe. Who knows? No inside information. But anyways, so Salesforce, yeah. There's a lot to like about Salesforce as far as the forward market opportunity. They just recently did another acquisition that I think is fairly interesting plug-in acquisition for them. So Salesforce current valuation, I view it more so on the fair value, not undervalued. I want to see it closer to like $220 a share. Last time I did a quick valuation on this. So the I was like, Andrew saying, do the everything money trading is my personal opinion.
He
Oh,
said
don't
don't
do.
do it. Yeah.
Oh, don't do.
I believe it or not, JJ Gillis, I regrettably have given it a try.
What?
Anyways, not to derail it. Yeah, like we'll go with Salesforce.
Yeah, Salesforce. I think this was one of the greatest buys in 2022. That doesn't help out with your question, but yeah, $220 a share is the price point that last time I checked would I be interested in buying more. After revising, even like Meta, when I looked at it again, it does seem clear to me that the valuation, the fair value of where I'd like to acquire more shares has gone up a lot. No, go figure, the business has improved a lot. And of your portfolio of between those three, Amazon, Google, and CRM, I'm more biased to lean that I think Amazon's the best opportunity between those three. But Google is a great business. I had my hate for Google owning it just because I feel like the management team is squandering the potential of the company. But I think the company's great. And the fact that you can have bad management and still things run okay is like, wow, insane. So yeah, Salesforce 220. I think that there's a really strong growth potential lever for them to pull in enterprise software for LLMs that are catered to specific businesses that also protect the data. And Mark Benioff talked about that in the last earnings call. If they can figure that out, then that's a massive opportunity for Salesforce. And there's a lot for them to land and expand into with all the software services that they offer. So I'm really happy to have it in my portfolio at the price that I have it. Would I want more? Abso-freaking-lutely, I want more Salesforce. So I think you and me, if we have so much Salesforce, I don't have a massive percentage, but nominally speaking, it's up there, and I'm happy with the percentage. But someone who has a healthy percentage allocation, I think, needs to consider maybe being a bit pickier on their allocations or how much more they contribute to it. But you know what? That being said, that's also not true in the sense that, you know, if you find a winner and it's winning, why not reward it more? Which I'm not adverse to it. Like I recently kept buying more into some of the winning plays that I've had, and leaning harder into them, not away from them. So I will be visiting the NYC office for Salesforce, trying to get insider info. Hey,
Yuck.
that's funny. All right. With that being said, everyone, thank you guys so much for watching this 3 hours and 24 minutes, but with timestamps. Let me know in the comments section if you guys liked this formatting, and I will be doing this from here on to the end of time during the live streams. If you guys like it, that it's more, you know, structured, and then I keep the panel if I have guests on or myself. I force us to go through these topics, also with some minor adjustments, because I did. If you guys refresh the page, you'll notice that the timestamps were changing if we kind of got over some. So yeah, thank you guys so much for watching. And if you guys are watching this and you're watching me on Twitter, you're not following me, follow me on Twitter, like it on Twitter, retweet it if you want to. And then if you're on YouTube, like, share, subscribe. Well, share it if you want to, but subscribe if you're not subscribed. I think most of you are subscribed. I get most of my audience's subscribers. And then if you're curious about the investing club, the link is in the description below. The price is increasing at the end of the month, which is like now. And also want to plug in a good friend of ours, 2 Accountants and 1 Gap. They talk about various accounting topics, more on the academic side. And they had me on recently to discuss B. Riley. So yeah, if you guys are interested in watching that, that's also there. And by the way, you guys are sharing the collaborative videos because you have Andrew, right? So all of them are collab. So you should be sharing them in the collab.
Yeah, no, I haven't. Yeah, because
Okay,
yeah, Andrew and I are the co-hosts for the show. Spoiler alert.
Yeah, they said I'm not invited anymore.
That
So
is
to
factually incorrect.
the last thing. Oh yeah, sorry. Fuhat says I have to give Twitch some love. I got some comments on Twitch sometimes. Yeah, if you're on Twitch, you're like the one person on Twitch. Hey, welcome.
Hi, Fuhat.
I am not a person with a bathtub, so it's not the typical Twitch thing, and I'm not playing a video game. But yeah, do your thing on Twitch. All right. With that being said, thank you guys so much for watching. I'll leave you guys with a nice little exit, and we'll be heading out.
Okay. We'll do it live. Okay. We'll do it live. F it. Do it live. I'll write it and we'll do it live. F***ing thing